Today, the Federal Open Market Committee kept its policy interest rate near zero. The committee also agreed to continue reducing its net asset purchases, bringing them to an end in early March. As I will explain, against a backdrop of elevated inflation and a strong labor market, our policy has been adapting to the evolving economic environment, and it will continue to do so.
Hey everybody, welcome to the show. Thank you so much for being here. Today we're going to be talking trading in the trend, and we've got an absolutely jam-packed event planned for you guys with over 4 hours of presentations from Shannon, Anne-Marie Baiynd, JC Parets, Scott Redler, Bob Desmond, Sara Strat Sniper, Rob Smith, and Michael Baiynd. So sit down, get comfortable, and let's get into it. Our first guest today is Shannon from alphatrends.net. This man is an absolute legend, creator of the anchored VWAP. He's going to be talking today about trading with the 5-day moving average. So Brian, absolute pleasure to have you on. Great to see your face and get to talk to you today.
Yeah, good to see you, Jason. It's been a while, hasn't it?
It has been a minute. I'm really excited for you to dig in on this 5 SMA. I've been following this for some time now.
Okay, cool. Well, let's just jump right in, I guess. So I am a swing trader, and, the topic here is trend trading. So to me, it doesn't matter if we're in an uptrend or a downtrend. Of course, right now, the market is in a pretty strong downtrend. And that's where I want to look at this market and say, where are my opportunities to be long or to be short? And for some reason, we just tested these arrows, but it's not moving to the next screen yet. Maybe because I have that pencil there. Okay. All right, here we go. Sorry for getting you dizzy there. Here's what we're going to cover today. Just real basics of market structure. And then we're going to go, talk about different time frames. The time frame I'm going to talk about is basically the intermediate term time frame. That's where the 5-day moving average has its most value. And we'll talk about different time frames as well. We'll talk about why I use a simple moving average versus an exponential moving average and why it doesn't really matter which one you use. How we use this information to anticipate market activity, and then set up our stop our trade plan, which includes our stops, and then participate once we have price confirmation on a shorter term time frame. So it's all comes together through trend alignment. I'm just kind of focused on the middle time frame here, and you're probably wondering, hey, if I'm talking, well, how come we're not talking about VWAP? I've done a lot of talks about VWAP, and I think that the 5-day moving average is something I've discussed a lot, but I haven't done a formal presentation on it. And to me, it's probably the absolute most important piece of the puzzle as far as keeping me from making mistakes in the market. I make it absolutely clear that I simply will not buy anything while it has a declining 5-day moving average. I will not short anything while it has a rising 5-day moving average. Again, that comes from the standpoint, the time frame that is of a trend swing trader. So it all depends on what your time frame is. There are no absolutes in the market. It's all about what works best for you. So you've probably seen this infographic. I've been floating it around the internet for the last 12 years. I think I created it in 2010. That's what it says on the copyright, at least. And this is basically, you've seen it before, not just from me, but this is, the 4 stages of the market. To Stan Weinstein and Wyckoff, they're the guys who kind of popularize this stuff. This is my version, basically, of just saying, here's where we are in a current market. I think that the market itself is somewhere over here, just starting to break down. And perhaps we continue a lot lower or we can turn back higher. The fact is we never know until after the fact where support and resistance lie on the bigger time frame. We have potential areas where we look for levels of interest, as I call them, for support or resistance. But what we want to do is use a simple tool, and a moving average is a very simple tool. It gives us a reference point, just kind of a constant to compare price trend to, so that we're looking at the stock and saying, are we in an uptrend? Are we in a downtrend? Or are we sideways? Because when we're in a sideways period and prices are moving up and down, above and below the 5-day moving average, or the same principles apply for a 50-day moving average on a longer term time frame, but we're focused on the 5 here. But when we're crossing above and below, it represents indecision. Indecision is defined as stage 1 and stage 3, where we have distribution before a decline or accumulation before a drop. We only know that it's actually distribution when it breaks down here. We look at it and say, hey, it has the potential that it can break down, but it only becomes a confirmed decline once we start seeing the actual pattern of lower highs and lower lows. Similarly, on the upside, we only know that it's an uptrend when we see that pattern of higher highs and higher lows. The moving average, in an uptrend will start to slope higher, and in a downtrend, it'll go from flat to start turning lower. So we want to be aware of the direction of the moving average, where we are in relation to it, how far away, above or below we are. So looking at a 65-minute time frame, and we'll talk about why a 65-minute time frame. I talk about it all the time. And the 5-day moving average on here. What you'll notice is if you go in and put if you go into your charting platform and put in moving average and then 5, what you'll probably see is something that looks like this. It kind of follows very close to the price action. And I know this because people say all the time, hey, Brian, I added the 5 moving average and it looks nothing like what yours does. So this orange is the 5-day moving average. And what we're looking at is actually 5 days. We're not looking at 5 periods. So when we're looking at a 65 period moving average, meaning each one of these candles is 65 minutes in length, what we're looking at is the average of the last 5 days, not 5 of these candles. And that's where the confusion comes from with people who just add 5 to their chart. So what we're looking at is, again, we're looking at these stages. Stage 3 distribution. We see the price crossing back and forth above and below the price action. And what I did too, by the way, down here, I asked on Twitter for people to submit some questions, and there were some good ones. So I took them and inserted them into this presentation so that I could answer them directly. So this person is asking, what should a stop loss be if we take a stock crossing above the 5-day moving average? Well, let's first consider what the trend of this stock is. We have this stage 3 distribution here, stage 3 and stage 3, and then these stage 1s. Well, you'll notice as I'm pointing these out is the bigger trend here is clearly lower because we have a series of lower highs and lower lows. So it's not a stock we want to buy. Instead, it's a stock we want to look at and say, here's a potential short candidate. So we wait for the 5-day moving average to turn sideways, and then as it makes a lower low, below that prior low right here, we want to short it here when we have confirmation that it's made a lower low using the definition of trend. And then our stop would go up here above the most recent relevant lower high. So that's where it would go. And as the stock breaks down and then continues and makes a new low at this point, then our stop gets lowered to this point, basically break even. As it breaks down again here, we lower our stop to this point. And as it breaks down here, you might have been stopped out at this point, depending on how tight you like to keep your stop. But as the stock turns sideways, we still see the 5-day moving averages declining. So I look at it and say, it's still guilty until proven innocent. I don't want to buy it just because it's above the 5-day moving average. What I want to do, if this was a primary uptrend, is I want to buy it as it makes a higher high above the flat to rising 5-day moving average. So you can see in here, it is in fact rising. It makes that higher high. And this is AXON, by the way. I put this together last night. And, the stock had a rally. And certainly you can make money buying stocks in downtrends, buying stocks long in a downtrend. But news and surprises tends to follow the direction of the trend. And because we're in a primary downtrend, it means that it's going to drop from 180 to 140 and then rally from 140 to 160. Well, guess what? 40 points of downside, 20 points of upside. And then another, 45 points of downside versus 30 points of upside. So the sum of the declines is always greater than the sum of the rallies in a downtrend. So why not go with the bigger piece? Why screw around with this stuff and try to buy, for instance, right here at that first higher high? Instead, I say avoid it. So it tried to break higher and it instead failed. So had you purchased it there, you should have been out here. The smarter thing is, what I do is I say, anticipate in stage 3 participate as we start to break down and make the lower low below the flat to declining 5-day moving average. So short here with a stop above there. As it breaks down, lower your stop to here. As it breaks another low, you put your stop here. So there's what we want is the definition of trend. We want to anticipate in stage 3, participate in stage 4, exit in stage 1 in here. That means cover our profits. We cover pieces along the way, but this is the last point to get out. And then over here, I don't buy these. I don't buy stocks and downtrends. I see it over and over again. People trying to buy stocks and downtrends, and they continue to get slammed. It happened yesterday with AFRM. The stock had a 20-30% run. It was up 10% on the day. They reported earnings, and it was down 30%. Look at PayPal. Look at all these garbage stocks like Facebook. It's a garbage stock. There's no business buying a stock where the institutions are clearly selling millions of shares each day. So focus on the stocks and uptrends. And unfortunately, in this market right now, it means oil names. It means maybe some of the metal names are going to start to percolate in here. But the tech stocks, they're in stage 4 declines. So we anticipate. So AXON, I drew this in last night, and it's actually doing this today. I did not get shorted. I'm short Nike today. But the point is that to where we want to put our stop loss is we want to use the definition of trend. So if we short here, and this is the most recent relevant lower high, because the definition of a downtrend is lower highs and lower lows. Well, if we short here and instead the stock goes like this, well, we need to get out based on the definition of trend. If I'm anticipating a continued downtrend that becomes in alignment with the bigger picture downtrend on the daily time frame, and then it reverses, well, I'm not a trend trader anymore. The definition of trend itself tells me I've got no business being short this stock any longer. So when we talk about moving average, I use simple moving averages, and really it doesn't matter which one you use: simple, exponential, volume weighted. Volume weighted is a different category. And if you know my work, you know that I like to use that from an event. It takes out the time component, the subjective time component, and adds in, the actual supply and demand based on volume, price, and time. The simple moving average is simply, here what we'll do is the exponential puts more weight on the recent prices. This is an example, I made it up, but of how a simple moving average versus an exponential moving average works. So in the simple moving average, each piece of information gets the exact same weighting. So day 1, 2, 3, 4, and 5 all get the same weight. They get 20%. Exponential, again, I made this formula up just to prove, just to show the point. But what happens is the most recent data gets more weighting. And you can see, so day 1 might get 15% versus, yesterday we'll get 25% of the weighting. So it speeds up the moving average. And some people will talk about the 20 EMA or 21 EMA versus the 20 simple day moving average. It's completely irrelevant which one you use, because what we're not doing is using them as a place to actually do business, but instead as a reference point to say, here is a level of interest. So on here, if I hadn't labeled them, you would have no idea that the blue one is a simple moving average and the green one is an exponential moving average. So you can say, well, shoot, see how good that exponential moving average worked? Well, then, and the simple moving average person might say, well, that one worked. And over here, the simple worked, and there the exponential worked. But what we're looking at them as a reference point, and this is where we start to see if we took this piece of the puzzle right here and we said, okay, we're going to take these daily candles and we're going to expand them. And it looks like this. This is what it would look like. Something along the lines of that, for what I've drawn out. Now, these will be days, and I'm not good at drawing them straight here, but let's just say these were days. And then we would have right up, so what we're looking at in here is, kind of like a 5-day moving average would come down and look like this. So what we want to do is we want to look at that 50-day moving average and say that's a reference point, something to compare price to. I don't want to buy there. Now, hindsight might say, but you should have bought there. That was the low. It's not my goal to buy the low. I want to buy when there's momentum. I want to buy when the trend is in my favor. I want to buy right here set my stop under here. If I bought right here, I have no assurance that like this time it wasn't going to do this and continue lower, and it would take 3 weeks to break even. And who knows, maybe you would have spit it out somewhere in here, just like this this person in here, maybe they got stopped out at break even. So I want to, look at the bigger picture for that trend alignment and say, here's the bigger trend. I'm not buying pullbacks. And if you know anything about my work, I put it on there all the time. Don't buy the dip because we don't know if it's a dip. Instead, we use it and say, here's a level of interest. Now I'm going to switch to a shorter term time frame and look for the evidence that the buyers are gaining control. Well, at the same time, you'll see that the volume weighted average price from this peak will look a lot like that. And then we can draw one off of here that looks like this, etc. So again, what we're talking about today is a small piece of the overall puzzle. It's not a moving average system. But when we talk about a dominant moving average, and that's what I like to look at, the 5-day moving average is the dominant moving average on an intermediate term time frame. And when I say that, dominant, it just basically means this is the most important weighting that I'm going to have on this one time frame. So I want to know, what's the direction of this moving average? What's the slope of it? Is it extended really, far above it? And I don't want to buy. I'm very picky about my buys. So if this is the stock, and here's the stock, and here's what that 5-day moving average looks like. I don't want to be the buyer up in here. I want to buy here. I don't want to buy the breakout because the breakout is late. If that was the prior high, I never buy these breakouts. And in fact, if I own it down here, I almost always sell a piece on the breakout to the breakout buyers because you'll notice, guess what? Breakouts don't typically work. People have been complaining about it for years. Hey, breakouts don't work. Well, of course they don't work because you're late. This stock already ran from 22 up to 25 and a half in 3 days. Well, guess what? The people who are up 10%, of course, they're going to give you some for your breakout and your bad execution and your chasing. It doesn't make any sense to buy that stock. So how far above or below it is really, a key piece to say, am I taking too much risk here? And then, position size management. So whatever the time frame is, if you're on a weekly time frame, you might be looking at a 40-week or 200-day moving average. On a daily time frame, maybe you're looking at the 50-day moving average. Just be aware, the 50-day moving average is rising, innocent till proven guilty. Don't look to short that stock. If it's declining, don't look to buy it. It's guilty till proven innocent. That alone could save you so much money. So what you'll notice when I talk about the 5-day moving average, I almost never, in fact, this is the first time I've actually put one on a daily time frame since I can't remember. But I was trying to make a point that, so in your book, Leo says you talk about the 10 and 20-day moving average. What's the advantage of the 5-day? Is it more helpful for short-term swing trading? I think absolutely it is. The markets have speeded up since I wrote that book 13, 14 years ago. And now I've found better value for short-term. I still consult the 20 and the 50 I talk about all the time. So what we see here is, it's not really a 5-day moving average until the end of the day. So if it's noon Eastern, the market's been open for 2.5 hours. And if we're looking at a daily chart, what we're looking at is 4 daily candles plus 2.5 hours of one day. So it's not really a 5-day moving average until the end of the day. So what is a trading day? It's 9:30 to 4. That's 6.5 hours. So, there's 390 minutes per day, meaning there's 1,950 minutes over the course of 5 days. So in order to, to find an even value, we have to have a denominator that can go into 1,950 evenly. So what we see is these are those numbers: 1, 2, 3, 5, 6, 10, 13, etc. So if you think about it, 195 times 10 is 1,950. So if we're looking at a 195-minute chart, that means there are 2 candles per day, and we would look at a 10-period moving average because there's 2 candles per day. We would look at 10 periods. So here's how we look at it. We want to, again, 1,950 minutes over the course of 5 days. It's not as confusing as it might look here if anyone's going, wait a minute, taking out their phones, taking a picture so they can review this later. But in order to see the 5-day moving average, again, over 5 days, the market is open for 1950 minutes. So we want to use candles that are evenly divided into 1950. So there's six, I always talk about a 65-minute chart instead of a 60-minute chart. It's simply because if we look at a 60-minute or hourly chart, the market's open from 9:30 to 10. That's 1/2 hour. The candle closes. Then from 10 to 11, 11 to 12, 12 to 1, 1 to 2, 2 to 3, 2 to 4, we have 6 more candles that are each 6 hours long. So we have one candle that's measuring 30 minutes of data, and we have 6 candles that are measuring 60 minutes of data. It'd be like taking a measuring stick and having 11 inches and 1 centimeter and trying to express things in how many feet long it is. It's not 1 foot long, it's 11 inches plus 1 centimeter. So we want to keep it consistent. 65 minutes, there are 6 equal candles per day. 78 minutes, there's 5 equal candles per day. 78 times 5 is 1950. 130, there's 3 of those per day. 130 times 15 is 1950. So when we look at, and this was through yesterday midday, this S&P 500, here's a 65-minute chart with the 5-day moving average. 65 times 30 is 1950. What we're doing is, you see this information over here, we're just zooming in on it. So we now look at a 30-minute period and we say, okay, there's 30 times 65 is 1950. Now we still have that 5-day moving average in the same spot. If we want greater detail and look at a 10-minute time frame, look at where the moving average stayed in the same place. So over 15 minutes, 15-minute candles, there was 130 of those in each 5 days. So here's how they look all together. And you can see that on the daily chart, on the 65-minute, on the 30-minute, and on the 15-minute, we have that moving average continuous on all the time frames. You don't just put 5 and then, again, if you put 5 on this, it would look like, like this. And if you put 5 on here, it would, a 5-period moving average would look like this. So we want to look at the 5-day moving average, not 5 periods for these other periods. So the way, a couple other questions I can answer here are, one of the easy stock trader said, the biggest moves are mean reversion bounces off a bottom. By using your 5-day moving average, aren't you saying bye-bye to all those opportunities? Even worse, isn't the biggest money made on the turns, which you'd sit out because of the 5-day moving average? Well, here's Apple through yesterday. And, the thing about it is, it seems in hindsight like, hey, well, that was the bottom. Okay, what told you this wasn't, or this wasn't, or this wasn't? This is guesswork. If anyone bought that, you were guessing. I promise it was guess. Instead, I'm okay not catching this, not being involved all through here. And instead, the day that it gaps up above the 5-day moving average, which is now rising, what we do is we simply switch to a shorter term time frame. And on that shorter term time frame, this is a 2-minute chart. So this is a 2-minute chart of this over here. These are 30-minute candles. This is 2 minutes. So it gapped up. That's this point right here. And then it immediately sold off, and we anchor a VWAP to the beginning of that day. As the stock makes this back above the flat to rising volume weighted average price, now I know that the buyers are back in control for that day, and that I can buy this stock here with a stop under there. Instead, maybe I guessed this was the low, or guessed that this was the breakout. Here I have confirmation that the buyers are in control. This is multiple time frame analysis. I wrote about this particular strategy, 13, 15 years ago, chase the gap or wait for VWAP. So it's about using multiple time frames so that I don't care if I don't catch that V reversal, because you might have thought this was the V reversal, this one, this one, this one. Instead, this way we're able to say, okay, I'm going to, keep raising my stop under the VWAP from that level. Maybe anchor one from here that starts to look like this and raise my stop up under there. But again, this isn't a VWAP presentation, so I'm trying to make it about, answering some questions as well. And this also answers Verinci's question, which is, can he show an example of entries and exits using this method on lower time frames? So there's one, and that was just in the last week in Apple, where it crossed back above the VWAP, and the biggest, most known stock on the planet. It works on all stocks. It works on all time frames. The concepts of the stock market, the technical analysis this is. Last about a week, 2 Fridays ago, I think it was, I was talking about the market and that it was starting to, we had seen that, this was the low was actually, you can't see the low. The low occurred on the 24th of January, which was over here. And it kind of did this, rallied up, got rejected at the 5-day moving average. It got above the 5-day, but the 5 was declining. And then on this day, we had a gap over here that came down to this. So I knew that the 5-day moving average, I was anticipating the direction of the 5-day moving average to rise. So I put on Twitter that I had got long here with a stop under that level. I got in and out of the trade. I also then said I got back in. I got back in here because I thought that was a shakeout. So, I'm not buying big pieces in here. This is a reversal trade. The 20-day moving average, the 50-day moving average are still declining. This was a high risk trade, even though, it hit the parameters for a, buy above that 5-day moving average. We were deeply oversold. Everyone was bearish and it was starting to turn. We had evidence. So I'm a trader. I'm going to take the trade. It's not my preferred trade. I prefer to trade when we have an alignment of trends. If I trade this long side in a primary downtrend, it's going to be with smaller share size because I have less confidence in it. And I'm typically going to go to something like the S&P versus trying to pick a bottom in a stock, because a bottom in a stock is much more elusive. The S&P, we can see, there's not that company specific parameters that are going to be a problem. So trend traders, you want to trade in the direction of the primary trend, and the simple moving average or exponential, who cares, right? Don't try to be all intellectual about the exponentials better because of this weighting or that. It's a bunch of horseshit. Either one is going to tell you the same exact thing in the same area. It's a level of interest to drill down to a shorter term time frame and look for evidence that the buyers are gaining control. And then if you find that evidence, you buy and set your stop. Risk management is always job number one. So if we are in a primary uptrend, so we have a stock in a primary uptrend, if it's in stage one, basically right here, we anticipate. We don't do anything. And then as it breaks to stage two, we participate. And then as it makes these higher highs and higher lows, we stay in and then we exit in stage three as it turns sideways. Let's say it looked like this. We exit in stage three, and then I'm going to avoid that pullback because it's most likely going to do this. I'm not looking to sell short this. But if instead we're in a primary downtrend, we flip it. It's the opposite. We anticipate in stage three, participate in stage four, exit stage one, avoid stage two. So the direction of the moving average is going to be more important than whether it closes above or below it. Be aware of that. Be aware of how far it's come. Has it expended all of its energy to get there? If the 5-day moving average on an intermediate term trend is declining, I look at it and say guilty till proven innocent. But I'm also looking at, where were we 5 days ago? What data are we replacing right now? Does this have a chance that it's going to flatten out? And if it breaks that higher high, I don't want to chase it the next morning. I want to be involved today. So there's all kinds of pieces. This is by no means a system of trading. It's one piece of the puzzle. I use, the weekly time frame. I use the daily time frame. I'll use the 65, the 30, the 15, the 10, the 2. I'll use whatever time frame I can get value from to help me hone in on what's the best point of action that I can get involved, where the buyers just start to take control, or right now where the sellers are starting to take control, so that I can get in right as the momentum begins. And that allows me to be aligned with the trend. So I know, we're in a downtrend. I want to short that very first weakness on the shorter term time frame. I can go in with bigger size because I know I have a tighter stop. If I'm risking 50 cents and if per share and I'm risking $1,000, well, I can trade 2,000 shares. Instead, if I wait for the stock to drop $2 and then I enter it, and my stop is $2 away, to risk that same $1,000, I can only trade 500 shares. I want to be as precise as possible because it allows me to maximize my gains for the same amount of risk. So again, it's a reference point. It's, if it's below the 50-day moving average, the 5-day moving average, whatever your time frame is, it's guilty till proven innocent while that moving average is declining. Even if it pops its head up above it for a day or two, if it's still declining, don't trust it. Only price pays. And whenever you get involved in a stock, ask these two questions. Where has it come from? I can't tell you that it happens all the time. When we're in a downtrend, I get questions right here about, hey, does this look like a short? It just dropped from 53 to 4, to 36. Hey, Brian, I think that looks like a short. No, it's where has it come from? Instead, I want to look at it and say, okay, now it's just starting to break down. Where has it come from? Well, right here, I can set my stop there. Where does it have the potential to go? Well, at least to this level. If it breaks down to there, I'm going to cover a third of it. But if it's truly in a longer term decline, who knows? Maybe it goes off the chart, into bankruptcy, hopefully, if I'm short the stock. Not to wish anything against the company, but, we want to make as much money as possible. So where has it come from? Where does it have the potential to go? That's how you determine your risk reward ratio. Is the potential for profit worth the perceived risk? And it's perceived risk. What if the stock gets bought out tomorrow and we're short it? We're stuck. That's why we have the position size as well. It's garbage in, garbage out. But we can put less smelly garbage into the equation by looking at the definition of trend and understanding market structure and anticipating how it flows. I wrote all about it in my book. You can find it on Amazon. It's been called one of the top 10 trading books ever written. Don't forget, only price pays. That'll do it, Jason. Hopefully I came in on time for what you guys are looking for.
Yeah, no, that you totally crushed it, Brian. That was awesome. I do have like maybe one or two follow-up questions for you on a couple of things.
Sure.
The first thing I'm curious about, it's actually kind of like just a single two-part question. On the example that you showed us with Apple, where you have the gap up, now price is above the 5-period or the 5-day moving average. And then you go down to the 2-minute and anchor off the start of the day to determine an entry point. Is that a
Yep.
pretty common process for you? Is that kind of how you would normally do something like this? I would think we would be looking for that gap to fill. We would be looking for a back test of the 5 SMA. So, yeah, if you could kind of
Yeah,
just
that
expand on that
is
a little bit.
because we were so sold out in this market, and Apple being the leader, that not all gaps get filled. It's a fallacy. That if they do get filled, a lot of times it doesn't matter for months. So when the momentum is there in the market leader, the biggest stock on the planet, the one that's been really holding up better than anyone else, the stock who reported earnings and it rallied, well, all the other stocks, a lot of the other stocks have been crushed on earnings. So it's not typically going to get filled. And the point here to this entry, Jason, and this is, again, I wrote an article about this called Chase the Gap or Wait for VWAP, because I used to wait for things like what you were saying, waiting for it to come back down and retest, that prior support resistance, which it did actually, or test the 5-day moving average and then get going. I got tired of, missing all these moves. So I discovered that, and this is a traditional VWAP. When I say anchored to, that's just a traditional VWAP. It's automatically anchored to the beginning of the day. But this tells me that, hey, something significant happened here on this gap higher. The market was oversold. We've seen a higher low in Apple. That 5-day moving average will begin to, starts to begin to rise here because we're getting rid of data from the beginning of the day 5 days ago over here. So if I don't chase that gap, let it settle down a little bit, and you can see it, it rallied up to 167 and came down to, 133. That, if you bought at 167, it's down at 163 in 3 minutes. I'd feel like a jackass personally. And so instead, I want to say, where do the buyers regain control for the time frame I'm entering? if I'm entering on this short-term time frame, really it just takes out this little high right here. It's above the VWAP. And then if I want to get involved there because I think this has the bigger potential on a longer time frame, and then set my stop under the low of the day, I know exactly what my risk is. So if it's 2 points and I'm risking $1,000, I'll buy 500 shares there. If it's $1 per share, I'll do 1,000 shares, let's say, if my risk unit is $1,000. So, as it makes that quick move, I'm almost always taking a third off. Then as it starts to do this, once it gets to this point, I raise my stop on the 2/3 balance right to here. So if it comes back down, I get stopped out. Well, I've taken a third off somewhere over here. I'm entered there. All three pieces are profitable. I'm certainly not going to let it come back down and take me out at a loss. And then I might, for half of that third, I might say, okay, it makes this high, it pulls back, it rallies up to here. Now I'm setting my stop on that second third right here. I get stopped out. I've got 1/3 left. I let it test VWAP. It comes back up right here. So, okay, that's where my final third will be. And maybe I'll even add to it some of the stuff that maybe I'll add a third of my original piece right here and put my entire stop under that level. And as it rallies quick, if I added another third, I would probably sell a third here most likely. And then I would start doing the same process, raising it up under these higher lows, and then probably getting stopped out as it turns sideways in here and saying, good enough, on to the next one. That's how I like to do it.
Our next guest today is Miss Anne-Marie Baiynd. Anne-Marie is the president and CEO of thetradingbook.com. And today she's going to go over some reliable ways to assess trend by using some simple elements of the chart environment. Anne-Marie, it's so nice to have you here today. It's lovely to see your face.
It's a pleasure to be here. I love any opportunity to talk about charts. So I am ready to geek it up.
Yeah, let's dig in. I hear you're gonna show us some things about some moving averages.
I absolutely am. And so if we just take a look at a chart, we'll just jump right in and see the XLE here. We're looking at it on a weekly, and I want to talk to you a little bit about the moving averages that I have and then how I assess them. So here you'll notice it says OHLC4. What that means is I have the open, the high, the low, and the close, and I've added them all together and divided by 4. So it could be that that number never touches the actual candlestick. But see, for me, looking at moving averages is more about how are they behaving, not have they crossed my particular price or not. So what I mean by that is the following. If we take a look over here where you see my cursor, you'll see that this 7 is sort of flattening out, but every week, because it's weekly candlesticks, they actually touch this moving average. So if this moving average is flat and it touches it, either crossing and closing above it, crossing and closing below it, whichever one it is, when it's flat, I say to myself, hang on, can I see a support ledge that might be holding? And if it fails, I know I have a problem. And so this is why I look at something that really just gives me a flavor of what the road is like. It smoothens out all the little peaks and troughs that chase us into trades when we don't need to hop into them. And so across the way, and having been in the space for really coming up on almost 20 years, what I notice is when I work with traders, they will say, hey, listen, did I cross the moving average? Am I sitting under it? I need to go short. And so if we just look at a corner of this edge, I liken it to this particular analogy that I use a lot. Let's say that you look outside and it's super sunny and you can feel the sun on your face as you look out the window, but you don't notice that there are no leaves on the trees. and you decide you're going to wear a tank top and a pair of shorts and some flip-flops, and you head out, and it just happens to be the one day of sunshine in March in Juneau, Alaska. You're going to be very uncomfortable. And so when we stare at a chart and we go, hey, that's under it. If it closes under it, I'm going short. That's like looking out of the window, seeing the sunshine, anticipating what you think is going to happen without paying attention to the rest of the environment. And you simply have to do that as a trader. And so what I like to do with this 7 is I like to look at the price action every time it failed the edge to find what kinds of relative support sit. So let's just go back here to where this lost it here. We'll start in the middle of the chart and we'll say, all right, let's go to the wick. And that's right about here. Now notice, if I had moved back here and drawn that same line, you would see that resistance broke out and got retested as support. Okay? Also a very, very important thing, but something to remember when you're looking at a line like this, it's not that you close below it, it's what happens after it closes below. And so I have 2 moving averages here. I have a 7, which is very fast, and I have a 50, which is very slow. And again, I use the open, high, low, close divided by 4. That's what that means. And so when it comes in, it's giving me an overall view of what is the landscape. So for energy, we can see that the price action is absolutely telling us, hey, listen, you buy the pullbacks. It's not really telling us to buy the breakouts. And here's why. First of all, when we look at support, we say, all right, I understand what's happening. When we look at resistance, it breaks through, but after the fact, it comes all the way back down here. So again, number 1, I'm not going to say never, but I'm going to say many times it's a very bad idea to say, I'm just going to buy this when it breaks out over this moving average, or if it breaks resistance and it looks like I've got bullish pressure. That's never a good way to pick up a position, because it's very likely to roll back over, at least to test your old prior resistance. And indeed, what it does is it breaks out, holds, but doesn't go higher, always a warning sign, comes all the way back down, and then actually reverts to the mean and comes right into the 50. And so here we are right now, and we're looking at it and we're thinking to ourselves, if you haven't been in energy and you're looking at it and you're thinking to yourself, oh, what did I miss? You're inclined to go, I'm just going to go ahead and buy it up here. But there are a couple of things that don't look very lovely at this juncture. One is the candlestick height is getting smaller as we go higher. Now, today's only Monday, so it's a little unfair for this guy to be penalized here. But the point is this. You've got to come to a space where you say to yourself, I'm getting involved, but you must answer the question, what's the risk? Listen, if there was no risk in trading, trading would be very easy, because you would look at a chart and you would say, yeah, it looks good, I'm going to buy it. And if you had bottomless pockets, like a few people on earth have almost bottomless pockets, you'd be just fine to hang on. And even if it went to 0, you'd go, well, that's it, I'll just find something else. But everything that we have, all our resources, are always finite. And so we have to say to ourselves, if I get involved in this trade, what's the risk that I have to accept that the trade could go against me. So we're going to do a couple of things. The first thing we realize is, hey, the trend is up. Here's what I like to say. If you look at a chart and your 7 is up and your 50 is up, you're in great shape to go, you know what? If it pulls back to a place that it held support, I'm going to buy there. Now, I love to sell puts when an environment looks like this. When I look at a weekly chart and I see that everything's moving up, I'll say to myself, where are you going to sell a put? And so I will look for the pricing to sell a put. Now, for those of us that don't know options very well, you might be terrified by that. So it might not be an option for you. What you could do is say, I'm not going to buy this until it comes down to 65, because when it comes down to 65, it could still come to 60. And that's 12% of an investment that I could lose if it fades here. Now, it might never fade here, but you have to look at this and say, wait, where am I going to say, okay, I got to get out of here? What we have a tendency to do is first think something's moving up, find a few things that go, hey, that's moving up for sure, and then we just buy it wherever it is, without realizing that price action will rotate. Take a look at this, right? This moved up, this was moving up, this moved up, it rotated back down. So it moved from 54 all the way back to 46. And then it bounced up again and it moved to 56 and then moved all the way back down to 46. That's a 20% move. So if you are looking as an investor in the chart, you could say, that's huge. I don't really want a 20% drawdown. If you've not had a 20% drawdown with a significant amount of cash, that's a terrible feeling. Trust me. Unfortunately, I know it. So I'm going to say to you, just don't do what I did in my early years, because I literally went from a very large beginning account to a very, very, very small account before I turned around and learned how to build it back, right? I was the worst trader you've ever met. I'm positive of it. So a lot of the mistakes that I made, I want you not to make them, which is why I'm sharing it. So you might say, okay, that's way too much time. These are weekly candlesticks. They're just rocketing all over the place. And I don't want to wait 1, 2, 3, 4. What if it takes 5 weeks to come back to that edge? I don't want to wait 5 weeks to get into position. Fair enough. If you look at something that's moving away, then you can collapse into your smaller formations. Notice it's still telling us the same thing. It's saying this is up and this is up. This is one of my favorite super simple indicators. It's a momentum indicator. I have it at 10, but you could do it at 12. It doesn't, you could pick whatever number you wanted, frankly. What you want to make sure is that you are above 0 and both your moving averages are straight up.
So once you know that these are trending up, the only thing you have to focus on is, what if I'm wrong? And here's the difference. If you're a trader, just a regular trader, and you're moving in and out of trades every week, every day, something like that, you're going to have a different set of rules than if you are a trader that is investing in something solid. So let's take a look at the energy sector and anticipate that it's going to be something that you want to trade, but it could easily be something that you would want to hold for a longer investment. My thought would be this. This is sitting here at 67, where all these wicks are. It's currently 69.80. If you want to engage in this chart, you must assume that at the very least, your chart will come down and test the region here. And so you can establish that risk by saying, all right, I'm going here because I think it's going to break out. Or you could say, hey, I'm going to go here and I'm going to wait for my price action to come to me. And so what you want to do is wait for it to come back and then hold above that edge. That's really, really important. You don't want it to touch it and then buy, because notice it touches it here, you buy it, and then it loses another $3. You want to let it touch and then recover. You'll have lots of opportunities if the price action is going to go in the right place. And so the key takeaways we have at this point of spending time together looking at charts is that in order for a trade to be successful in its building, you have to see three things. You want to see the small trend moving up. You want to see the large trend moving up. You want to see momentum moving up. And so let's just go through a ton of these and we can go yes or no. So here is XLV, right? That is healthcare. What do we see here, right? If you look at this and you go, what am I looking at? This is down, but overall it's really up. And this is down, but then this part is up, and then this is up. Not clear at all. It's not going to be clear until we probably get up and over this edge. If we get up and over this edge, then we'll be above that 50. And this is very likely to be trending. So we can go, nope, not ready for me. Not ready for me at all. Then we can go to the material space. Now you might say, why are we talking about these ETFs? And we were discussing this earlier. And the premise is that because the bond market is a little bit nervous about, hey, what's going to happen with rates, a very small move in rates can mean something disastrous if you've got a bond product. And so a lot of bond holders are cashing out and moving into ETFs. And so we're just going to be watching for them to do that. So here we are. This is materials. And it, again, looks terrible. You might say, okay, Anne-Marie, what if I want to go short? Here's what you've got. First thing, you want to make sure that this is below zero down here with your momentum indicator, right? You just want to draw the zero line so you can always tell what's going on in general, right? So yes, it's flattening out. This is down, and then this is down, but it just moved up. So how do you make a decision about what to do right here? You can say to yourself, well, what do I want the chart to do if it goes to the south? I want it to head down to its old lows. Where do I know I'm going to be wrong? Well, look at what just happened with this upward moving 7. If I fail, and I'm thinking that I want to go long, but it's really going to go up to my 50 simple moving average, it's going to bounce back up through the space. So you know, at the very least, if you go short, that your stop needs to be somewhere around 84, right? This is down, this could be going down, and this could be going down. What would I say? You know what? Wait a little bit. Chances are what's going to happen is it's going to come down into this area and then bounce. But clearly you can see that nothing looks as simple as energy, and yet we still had to look at the chart and say, you know, where is my risk going to be adequately discerned? And that's very, very important. All right, so now let's take a look at the communication sector. AT&T last week slashed its dividend in half. And so what that tells me is there's a problem here. So let's look at how nicely this says we could have a position. This is a do or die for this chart. It's come in on the bottom. Notice everything's down. It bounced up into the 50, turned around, and now it's down here at the bottom. If this continues to turn and these guys stay negative, this is going to break down. So the question might be, where do you want to take that trade to? But it's clearly telling us that we've got some shorting pressure here, most definitely, right? So where would it go? We would go, notice, in order to find a potential target, I moved to a bigger price point, a bigger time frame, so that I could see where heavy congestion or old resistance equal to new support. And that's going to be this area. So if this chart continues, it's going to be down into this area, most certainly, and I suspect that's what's going to happen. So notice the next question would be, where's my risk? You've got to assess risk. Every time you get into a trade, you have to think, what if I'm wrong? What if I'm wrong? And so this bounce, look at how tall this wick is. It's huge. Let's go back to the daily and see if we need to have a wick that big. Yeah, that's terrible. But yeah, we maybe could make it 73, right? But that's still about $3.50 from that formation. And you know they're going to try and bounce here. Why? Because 1, 2, 3, 4, 5 days in a row, they came into the area and they said, you know what, I'm going to bounce. And they did it on Friday right there as well. So if it fades, let it bounce. If it can't get up over this line, you're going to be great. You're going to be able to run it for, I don't know, what number is that? 6, 4, 24, 10%. Maybe 8%, and then you'll have to take some profit. So that's really how you clearly assess. And you can go through a ton of charts this way because you're just looking for what works. So here's momentum. These are the financials. Financials always do well under areas of rising interest rates. And the reason for that, well, there's a slurry of reasons. What we can see here, though, is a chart that's a little bit messy. Yes, it's bullish. Momentum is up. The trend of the 7 is up, but the trend of the 50 is a little bit flat. So what that tells you, when a trend is flattening out like that, it tells you that price will come back to you if you're patient. So instead of jumping in here at 40, you can say, you know what? I'm going to see if this thing pulls back into 39.50, and then I'll be able to take it to 40.50. And if you're buying options, that's a great place to look for that particular style of trade. Now notice, the reason I said absolutely you've got to wait for it to pull back is because this 50 is not very friendly. Chances are, if this 50 is going to turn up, notice, see how this 50 is flat here, and then price action moves up and it continues. What you always see in these kinds of environments are traders that try to pull us back into the area of resistance. So if you buy a breakout because A, your momentum is above 0, B, your 7 is moving up, and C, you're above your 5, and you can look to the left and see, well, wait a second, my trend was up in the first place there, and you buy that breakout, the second it stops heading higher on the close of the day, if you have 2 or 3 days that look like this, you have to say, I have to take some profit. That's what a trader would do. An investor would hold in for the longer haul because they're watching the overall trend of that 50. I think we have time for maybe one more. Let's take a look at SPY. SPY, a pretty messy patch. Notice momentum says traders are coming in and they're trying to get themselves up and over certain measures of resistance. So my 7 is up, my momentum is up, but my 50 is down. Look at what happens when the 50 is down, but the 7 and the momentum are up. What that tells us is I'm going to run into the 50 and I'm going to pull back. If I can hold my old support, that was resistance, I'm going to be in good shape. And so you have to let the chart settle out and decide, let the traders decide what they're going to do, and then you play along. When will this chart clean itself up? Well, it's got to break to the north, right? Old resistance, let's move that up here, is support here, support here. You might go, oh, I might have taken it short there. Well, you wouldn't want to take it short because the 50 is moving up, right? And this is mean reversion. It's when numbers come back into the big, long moving averages over time. You want to make sure that when it comes into that area, you're able to say, wait a second, it's got to get up and over that zone, and then I'll be able to trade it into its old highs. Hopefully that gives you a really simple eyeball of saying, I could trade this, I can trade that, I can't trade this, I can't trade that. It's a very straightforward way to look at anything that you're using to go, okay, that's going to be easy in terms of settling things down, or that's going to take a little bit of waiting before I get back on the right track.
This is awesome. First off, what makes you choose the 7 period for your quick MA?
A couple of different reasons. I like it because the second I close under it or I touch it during the day, I know something is going on. And so I use it to help me gauge the swift action of the market. If I'm really trading very aggressively, I'll use a tighter one. I might use a 6, I might use a 5, right? But that's for very big time frames, daily, weekly, monthly, that sort of thing. The tighter the moving average is, the larger the time frame, its usefulness in the larger time frame, right? It gets a little messy if you're on a 5-minute chart and you're using, a 6 or a 5 simple moving average. It's just going to be very, very messy. So the short answer is it's generally arbitrary. But what I like to say is, hey, listen, if it closes or touches that moving average during the day, at the end of the day, I'm going to look at the low and I'm going to go, all right, if I lose that edge, I'm going to have to be very careful about what's going to happen next. And you can see that really work over and over and over again. Here, it loses the edge. The very next day, it breaks right up above it. Here, it loses the edge. I look over here and I go, all right, that's my support is all the way down here at this wick. Do I want to get out or do I want to risk losing 7, 8 points or more? And so that automatically tells me, hey, if it breaks down, look for support or look for resistance. Very, very key element. And it keeps me out of bad trades as I'm assessing them for swings.
Is there a particular amount of time once it breaks down off of that edge or breaks up or whatever direction it goes? Is there a particular amount of time that you wait? Is there, other confirmation that you're waiting to see before you're willing to get in or out?
Excellent question. So the bottom line is, have I looked outside to see if there are any leaves on the tree? So what that means is, from the early analogy, if I break it, I first need to look for where my support ledge is. And then I say, all right, I have to figure out whether I want to take profit here or if I want to let it ride. If I let it ride, where could it go to? Well, the first place it could go to is old support. The second place it could go to is the upward moving average. Now, the moving average is upward, so if I'm a swing trader, I'm going to say, you know what? I'm sure that's going into the 50. I'm going to add to my position. Because if this is up and this is up and I'm over zero, I'm going to have buying opportunities. And so if it's down, I've got reversion to the mean coming back into the 50, and I'm going to buy there. But if I'm an intraday trader or a swing trader that is looking at a very short time frame intraday, as soon as it loses that, I'm going to say, wait a second. If it loses that, the next day it either has to breach and close over the top, or if it breaks the low of the day that I have as breaking it, if it breaks that low where my error is, where my cursor is right there, it's telling me, hey, you need to cut and run because this could fade another amount. So it's not how much time, it's what do they do at those prices.
So you're watching the previous day's highs or lows as an initial spot?
Yes, exactly.
Got it.
After it's crossed that moving average.
Got it. So I guess then last question for you, because we are about out of time here. Based off of what you're seeing here across these indices, or across these ETFs rather, what looks the best to you right now? Where's the opportunity at, and where is the where should maybe people be a little concerned about going long, and where should people be kind of looking for rotation to kind of find itself?
That's a really good question. I think it's probably better to look at weekly charts to establish that. So I'm going to look at, listen, my suspicion is commodities are going to head higher. Materials are going to head higher. And by materials, I mean not only soft commodities like wheat and soy and that sort of thing, but hard commodities like copper and steel and gold and all those sorts of things, because we're just going to have ourselves a little bit of a crunch. And so I expect a lot of these things to break out. I expect gold to break out. I expect the dollar to continue to rise. I expect energies to continue to move. If our interest rates do rise, the things that are going to get hurt are emerging markets, because all of them have US debt. If the dollar rises, it means their debt is also going to rise, because it's going to take more of their dollars to pay the US back. Not that anybody ever pays anybody back anymore. They just default on their loans, which, how many times has Argentina done that? I think 3. So that being said, that's where I would look. I would look at commodities. I would look at energies. And by commodities in the gold space, I would look for miners that have good looking charts. Let's see if Hecla does right now. Nope, Hecla does not right now. And so, it's all a wait state. You have to wait for these things to stop heading lower before you say to yourself, I'm picking a trade here and I'm just going to enter in. A lot of us have a tendency to do that. We'll say, no, this is the bottom, and it's not stopped heading lower. So I would say those are the areas to look.
Awesome. Well, Anne-Marie, this has been a pleasure. Super cool to get to chat. Super cool to get to chat with you. And thank you so much for your insights here. This has been great. And really look forward to talking to you again in the future.
Super. Thanks so much.
Next up, we've got the CEO of All Star Charts, winemaker extraordinaire, Mr. JC Parets. Sir, it's a pleasure to have you on today. How are you doing?
I am doing fantastic. You know, we got some charts lined up. I want to walk through sort of what I'm seeing around the world, and maybe you agree, maybe not, but I think it'll be fun either way.
Awesome. Well, let's jump right in.
So, um, let's get into it. You know, so for me, I hate to be like Mr. Bond Market guy in you know, in a conversation about the stock market, right? But you really can't have a serious conversation about the stock market without first understanding what's happening in bonds, because that's really what drives everything. You know, these little small cap stocks and the IPOs and the crypto and all that stuff, like none of that stuff matters in the real world. I mean, we're talking about a couple billion here, 5 billion there. You know, Ethereum might be half a trillion or a trillion. Great, you got $2.5 trillion market. That and zero might as well be the same thing. You know, when you look at these small cap stocks and some of these little names, you know, the larger institutions just can't participate in those markets just because they'd have to buy the whole company for it to even be worth their while. So they stay away from it completely. Where you really see the largest institutions in the world have to participate is in the bond market. So depending on what's being pulled, the levers being pulled at the largest market level that there is, you can see that trickle down into the stock market. So it really starts there. So coming into the month of February, we continue to see higher highs, higher lows in the stock market, and just no bid whatsoever in precious metals or in US Treasury bonds, right? These are, you know, assets that we're interested in the direction, and one's going up and the other ones are not. So that's interesting. And then coming into February, we look back at January, and what stands out? What stands out is that energy was up almost 20% in January and everything else was down. Financials were up a little tiny bit. So what's really interesting is that the types of stocks that tend to do best when interest rates are rising happen to be energy and financials, which we'll get into in a minute. Those were the best performing sectors in January. The worst areas were, you know, some of those growth names, which we'll get into as well. This is the trend that I don't think people are paying attention to. And getting back to the bond market, I can't have a serious conversation about the stock market without talking about what's happening in bonds. There's a third asset class. And, you know, if you're new around these parks and you just started trading, you know, you just think it's stocks and bonds. And maybe you even think it's just stocks, right? But there are three asset classes. And if you've been around for more than 10, 15 years, you have participated in markets where commodities are the leaders, where interest rates are going up, where growth stocks are underperforming. That's perfectly normal. And at this point, I just wanted to see where we're at on the time. So just so I can keep track of that. Oh, there we are. I see it. Cool. All right. So what are we seeing here? We're looking at the S&P 500 as the numerator and the CRB index, the commodities index, as the denominator. So as this trend was going down from the late 90s down to 2008, that was commodities outperforming the S&P. That's stocks underperforming commodities. I remember it well. It was the first cycle of my career. You know, I never forget it. You know, a lot of learning experiences. We were buying financials, Merrill Lynch, Lehman Brothers, Bear Stearns. We were buying like industrial conglomerates and Peabody Energy. Those were, you know, Chesapeake Energy. Those are the types of stocks we were buying in that environment. Technology stocks were an afterthought. Growth stocks were the areas you wanted to avoid. By the way, interest rates were going up during this period. And then what happened in 2008? That turned. And stocks were really the outperformer for a long, long, long time, well over a decade. And commodities were underperforming to the point where people forgot that commodities are even an asset class, which is hilarious, right? And here we are, the S&P making new 2-year lows relative to commodities. So if you talk about whether stocks are in a bear market, they most certainly are when you compare them to commodities. Looking at sentiment briefly, you know, we're getting the most pessimistic levels that we've seen in years. This is the average bulls between Investor Intelligence and AAII. So this is the average of both individual investors and financial advisors. And there are the fewest amount of bulls since 2016. How about that? Fewest amount of bulls since 2016. There are fewer bulls now than during COVID when we were like staring into the abyss, right? Most bears since COVID, right? So this takes the average bears of the AAII and the II polls. Most bears since COVID. So is this a bull? So the question becomes, is sentiment unwinding, right? Because in the summer, sentiment was a headwind. And if you look in the summer, we had the fewest amount of bears in like 3-4 years, and we had the most amount of bulls in 3-4 years. So sentiment was a headwind. This summer, everybody was like, oh, everybody's making money. The world is great. Nope. Right? Now it's the exact opposite. Now everybody's running, running and running harder than before COVID. Fewer bulls since 2016. This is pre-COVID, pre-Trump. That was like a long time ago, right? And then here's the bull-bear spread. So this is the difference between the bulls and the bears. And as you can see, the lowest levels, the most pessimistic levels since COVID. So again, I want to ask the question because I don't know. None of us know what's going to happen next, but we want to ask, has sentiment unwound or is sentiment still unwinding? I think that sentiment is more of a tailwind than a headwind, but the unwinding process seems to be still in that process. Maybe seems obviously based on the data, it seems like we're close to that washout. I don't think we're quite there just yet. Here's the value line geometric index. I was asked, JC, for newer traders, for newer investors, can you help them, show them how you analyze trends, how you look for opportunities? Are we in a bear market? So that was my homework assignment. So I'm trying to sort of put things in perspective to answer those questions as best as I can. And when you talk about stocks, we talk about stocks as an asset class, not just US stocks, not just large cap growth stocks, but stocks as an asset class. The value line geometric index might be the best gauge of equities that I know of. And it gets talked about very little. It's got 1,700 stocks of all market caps. And, we broke out of a 20-year base. And now we've just been consolidating in this sort of hot mess. So the resolution out of this consolidation in the value line geometric index, I think is going to give us a lot of information as to whether the next direction of stocks is 20% higher or 20% lower. And then here's the Dow Jones Composite Index, which I think is a great gauge for the stock market. This includes all 30 stocks in the Dow Jones Industrial Average, which you may have heard of. It's a big deal. Then you've got the Dow Jones Transportation Average with 20 stocks. And then you got the Dow Jones Utilities Average with 15 stocks. So 65 stocks total that make the Dow Jones Composite Index. And I think this is a good way to look at what the stock market looks like right now, somewhere in the middle between overhead supply and support underneath. So as long as we're above 11,200 in the Dow Composite, I think everything's fine. This is more of a rotation than a distribution. But if we were to break that support, I would argue more for the latter, more of distributive behavior, which is more evidence of a bear market versus a consolidation within an ongoing bull market, which seems to be the overwhelming amount of evidence is pointing to this being a consolidation, a rotation within an ongoing structural bull market, particularly when you look overseas. And then here we're looking at seasonalities, which last year's seasonals, really followed to a T. And I'm not Mr. one of these seasonal guys where this seasonalities trend says that this is a bad month, so sell everything. It doesn't work that way. But it is nice to have sort of a roadmap, right? This is what the market tends to do during this period. Because for me, the better information is when the market ignores seasonal trends. That if it's really strong in a bearish time or really weak in what's supposed to be a strong time, that's information. Because if it's not going up when it's supposed to, there's larger forces at work. And if it's going up when it's supposed to be going down, that's good, So that's historically a good measure. So what are we doing? So this is last year and this year. Red is the actual S&P, blue is the seasonal trends. What are we doing? We're making a composite. We're taking every single year going back to 1950. We're taking every post-election year for last year's data, every midterm year for this year's data. And then we're taking every first year of every decade in the decennial cycle for last year and every second year of each decade for the decennial cycle for this year's data. And that's what that blue line looks like. So, historically, we should see strength into the spring. And then that Q2, Q3 period is traditionally the worst time of the 4-year presidential cycle. So just know that going in. So, that's just a guideline of what the world should look like based on seasonal tendencies. And then whether or not the market acknowledges those seasonal trends, right, and follows those seasonal trends. If it doesn't, that to me is the better information. And so the TLDR of it here is that the market is following seasonal trends, so there's nothing to talk about. So here's the small cap index, which everybody's talking about, which has gotten murdered. And by the way, do I have the chart? Of course I have the chart. Of course JC brought the chart. So here, just to be clear, because people are like, oh, small caps didn't do well last year. Just to be clear, small cap growth stocks didn't do well last year. Small cap value stocks did great. The S&P was up 27, 28%. Guess what? So was small cap value. So small cap value kept up with all of the large cap indexes just fine. Thank you very much. It was the small cap growth stocks that were unable to keep up. And that is why the Russell 2000 looks like this, right? Because it's got all that growth in it. If it was just value, it would look much better. So just to put things in perspective, the small cap growth relative to small cap value peaked last February, right? And then you had that large cap growth relative strength into the end of last year, and then that just completely fell apart. But the way I want to ask my question is, are these charts I want to be buying? Just like that, like you wake up on Monday and you're like, I got money to put to work. What am I buying? Is this what you're buying? I certainly don't want to buy charts that look like this. And if you're buying growth stocks, you're buying these charts. I'd rather be continuing to be selling these charts. So in other words, focusing more on the value areas, less so on the growth areas. That's just the trend. Because if you really want to buy those growth stocks because you are a growth investor, because you think that that's a thing, then you're buying these charts, which I am certainly not buying these charts. And by the way, it's important to study other market cycles. I lived and traded through 2003 to 2006. Some of you didn't. I encourage you to go study. I mean, I know I could tell you everything about 1987. I can tell you about the panics in the 1800s, because I've studied them, not because I was actually there. So I don't necessarily think you have to be there. In this case, I was there in 2003 to 2006. By the way, when interest rates were going up, where large cap growth was underperforming value, when small cap growth was underperforming value. So technology stocks were an afterthought earlier in my career. Afterthought. Nobody's buying tech stocks. And if you were frustrated because you were buying tech stocks when you should have been in the banks and in the energy stocks, right? So I think that's a really, really important concept to understand, that we've been here before. This is not anything new. And then here, what are we seeing? We're seeing new lows in large cap growth on a relative basis, new multi-year lows in small cap growth on a relative basis. And then these are the culprits, right? The market peaked in February. So when people are like, oh, are we in a bear market? It's like, well, we've been in a bear market for a year in certain aspects of the market, particularly growth. Biotech's peaked last February. The anniversary was yesterday. Literally, the 9th was yesterday. And I think the advanced decline line peaked like on the 8th. So it was like the 8th and the 9th of February last year is when everything topped, not everything, when the majority of assets made new highs. That was it. That was a 52-week high list, peaked, all that stuff peaked in February. And then it's just been deterioration from there, which we'll discuss in a minute. But you can see biotechnology getting destroyed, Chinese internet destroyed, anything that Cathie Wood manages murdered, IPO index destroyed. And the IPO index, by the way, is probably the cleanest gauge, the best microcosm of that whole trade unraveling. You could really see it in the IPO index. Like that's really, you want the cheat code for that disaster. It's the IPO index for sure. By the way, if you're interested in these slides, please email me info@allstarcharts.com. That's info@allstarcharts.com, and make sure to use the password, because if you don't send me the password, you're going to get, some palm oil futures presentation I gave in Malaysia last week or something. So, make sure to use the password. The trend is your friend. Info@allstarcharts.com. The trend is your friend. So here's what I'm talking about. We're looking at the percentage of stocks down 20% or more. 75% of the NASDAQs lost 20%. Are we in a bear market? What the hell do you call that? Is that a bull market? 20% of the NASDAQ, 75% of the NASDAQs down 20%. Yeah, they're in a bear market. Half the NASDAQ has been cut in half. So people are asking me, are we going to enter a bear market? Where the hell you been? Where you been? What do you call that? Does that sound like a healthy market to you? And you can really see the difference between the NASDAQ and the New York Stock Exchange, where you only have 47% of the NASDAQ lost 20%, and only 13% of the New York Stock Exchange has been cut in half. So half the NASDAQ's been cut in half. Only 13% of the New York Stock Exchange composite has been cut in half. So you're noticing the dynamic difference. And why is that? First of all, you have a lot more value exposure in the New York Stock Exchange than you do growth. The NASDAQ has no banks, no energy, no materials, right? So it's just different compositions of what's in the NASDAQ versus what's on the New York Stock Exchange composite. Also, a third of the largest 100 components of the New York Stock Exchange are not even from the United States. They're foreign companies, where traditionally you're going to get a lot more financials, a lot more natural resources than you are in those growth-heavy American names. So for a multitude of reasons, you're seeing that dynamic, that major difference between New York Stock Exchange and the NASDAQ, where I'll repeat it again, 75% of the NASDAQ is down 20%. If you think that's a bull market, you're on drugs. And half the NASDAQ's been cut in half. So if you think that's a bull market, again, you need to see a therapist. The NASDAQ composite, when you look at the average drawdown of stocks in the NASDAQ, the average stock is down 45%. If the average stock is down 45% and you think that that is a bull market, I would question everything you're doing in life. So what does that mean? Is the bear market now behind us? Great, JC. It's so bad it's good, right? Maybe. Maybe. I think we're close. I mean, we looked at those sentiment gauges, right? They're pretty bearish. You know what I'm saying? Everybody, it's interesting, but sentiment is just sentiment. It's a supplement to price. The only thing that's going to pay us is price. So for me here, we're looking at the NASDAQ, and this is we just talked about how bad it's been underneath the surface. 350 is that level. So if we're above 350, the world is not coming to an end. That's how I look at it. Below 350, things are getting hairy. Things can get hairy below 350. But even if we're above 350, this is not an uptrend. So it's a sideways mess at best. Just because the world isn't coming to an end doesn't mean it's getting better, right? And why is all this happening? It all comes back to bonds. Again, I hate to be Mr. Bond guy in a stock market conversation, but I'm going to be Mr. Bond guy in a stock market conversation. That's just what it is. And this is why all of those dynamics are taking place, because when interest rates are going up, you're going to get a relative bid out of the more cyclical, value-oriented areas of the stock market. Money's going to be coming out of those growth areas. And I'm a technician. I'm not Mr. Fundamental Analyst guy. I'm not Mr. I fucking hate spreadsheets, right? I hate them so much. I look at charts. I look at pictures all day, right? But I have friends, I have associates that do the fundamental stuff. And I've seen like when the interest rates just move a little bit, because the earnings, it's the long duration trade. Like you're not getting your earnings until 10 years from now. So because of that, when interest rates go up a little bit, the income just gets crushed. So even little, again, I'm not going to pretend to know about fundamentals, but I've seen the spreadsheets, and then I tell them to take it away. I can't look at them too much. You go blind. But you could really see the changes in income. So it's not, that's the bigger reason why all of this is happening. So what stocks do well when interest rates are going up? Here's the Equities for Rising Rates ETF, EQRR, which is a basket of stocks that do well as rates are going up. And then when you look inside that ETF, more than half those names are energy and financials. Duh. Makes perfect sense. And then when you take the financials index and the energy index and you equally weight them, you get this black line. And notice how the black line and the blue line look exactly the same, right? Looks like the US 10-year yield, obviously, right? So I hope you're understanding sort of everything that's going on. Look at financials. Financials do not look like small cap growth stocks, right? They don't look, I showed you a bunch of small cap growth stocks before. They don't look like this. Financials breaking out of a 14-year base to new all-time highs. Berkshire Hathaway, new all-time highs. Berkshire Hathaway is literally the freaking definition of a value stock. Like industrials, financials, banks, just obnoxiously, the Graham book. What's the Graham book? The fundamental book that everybody, it's like the Edwards and McGee of fundamentals. I can't believe I'm messing that up. I'm not even busting balls. I literally just slipped my mind. What's his name? Whatever. The famous fundamental book that obviously all the Buffett disciples abide by. So when we're talking about the money rotating out of growth and into value, like Berkshire Hathaway is hello, it's like the freaking poster child of value, and you're seeing it perform. Look at Morgan Stanley breaking out of a 20-year base. If we're above those 2000 highs, I think you stay long Morgan Stanley, target up near 150. So I think you're understanding. First, we want to identify what type of market environment we're in. Which stocks tend to do well in that environment, which stocks tend to do poorly. and work our way down to the indexes, to the sector level, and ultimately the stocks. So by the time that we're like, okay, we want to stay long Morgan Stanley, right? There are so many other reasons why we're buying Morgan Stanley than just the chart of Morgan Stanley. Like by the time we get to Morgan Stanley, like 95% of the reason we're buying Morgan Stanley has nothing to do with the chart of Morgan Stanley, right? That's what that top-down approach is all about. And you're really seeing rotation. Also people are like, oh, I'm a growth investor. Why? Because growth stocks have done so well the last 10 years. That's why you're a growth investor? Sweet, dude. And then some people are like, oh, I only buy US stocks. And it's like, why do you only buy US stocks? Because they're the ones that did great the last 10 years? Yeah, that's brilliant. There were times in the past when foreign stocks were the outperformers and the US stocks were the underperformers. It just hasn't been the case the last 10 years. It doesn't mean that it wasn't the case before that, and it's not going to be the case in the future. So understand that every cycle is different. So here's the global Dow making new all-time highs. By the way, speaking of which, here's 2003 to 2007. By the way, when interest rates were rising, but that's another story. I hate to keep saying that, but it all comes back to bonds. In black, we're looking at the EFA relative to the S&P. So EFA is the developed markets around the world, ex North America. So think everybody developed outside of US and Canada. So think a lot of Europe, obviously, a lot of Japan, little Australia sprinkled in there, like what's the salt guy, you know what I mean? Little Aussie in there. So think Germany, obviously, France, and all that stuff. Going from the lower left to the upper right. This is international stocks outperforming. By the way, emerging markets also outperforming in that environment, EEM, relative to SPY from the lower left to the upper right. American stocks were the last place you wanted to be. By the way, interest rates were going up. Technology stocks were the last place you wanted to be. There were terrible places to be. So let's go to today. What are we seeing here? The 2018 highs. And here we're looking at the AVWAP. So this is the rest of the world outside the United States. And then here we're looking at the EFA, which we just looked at. These are relative to the S&P 500. These are on an absolute basis. So this is just the absolute charts themselves. The bottom line is this. If we're above the 2018 highs, the world is not coming to an end. Bad things are not happening if these two indexes are above the 2018 highs. I repeat, bad things are not happening if these two charts are above the 2018 highs. Period. End of statement. Bad things happen only below these levels, only below the 2018 highs. If there's any chart you take away from this presentation, it's this one. And then here, emerging markets. Where did they stop going up in 2020? They stopped going up at the exact same place they stopped going up in 2007. The academics will tell you that's just a coincidence, JC. Technical analysis is voodoo. They'll tell you that. Some of them actually believe it. Most of them don't, but some of them actually do. And then, not to be like Mr. like pattern guy, but like this is like looks like a falling wedge to me. Like I took my CMT exams like a zillion years ago, so I'm not like that great with the, with the heads and the shoulders and the Maribozus and all that stuff. Like you forget. But I understand, I remember something. This looks like a falling wedge to me, at a logical level. A breakout there and emerging markets coming out of 13-year base. Seems like pretty freaking bullish to me. And then, notice how Latin America made new lows in 2020. Brazil did not. We have seen tremendous strength out of Brazil this year. I remember markets are getting slaughtered early in January, and I'm seeing Brazil making new multi-month highs. And people are like, JC, nobody cares about Brazil. Oh, we trade growth stocks here in America. And it's like, well, that sucks because Brazil is breaking out. And there are ADRs. You could either buy EWZ as an ETF. You could have bought Petrobras. I mean, there's ways to express a thesis bullish in Brazil that is not YOLOing Tesla calls or like, bottom fishing ARK funds or whatever it is that you're doing. Looking for relative strength, I think is advantageous. Here's the Brazilian Bovespa that's priced in local currency, finding support at a key level here at 100,000. Mexico has been tremendous outperformer, not just in Latin America. I mean, I guess especially in Latin America, because everything else nothing in Latin America looks like this. But I would say globally and emerging markets, a ton of relative strength out of Mexico. Frontier markets pushing up against multi-year highs as well. These are like, classic safe havens like Kazakhstan and Nigeria and stuff like that. So if money is flowing into these areas, it's obviously not fleeing into safety, but, going down the risk curve. When you talk about China, the disaster it's been, the A shares don't look that bad. They don't look that, the chart doesn't look great. I mean, it's like range bound. That's not that bad, right? So that, that's interesting. So if you're in, the way I learned it is that bottom fishing can be very hazardous to your wealth, right? So I'm more of like a buy the breakout, buy relative strength. But if you have to bottom fish and you're looking to look for the worst garbage in the world, Alibaba is not the worst. If it's above 120, long Alibaba, target near 160. If we're below 120, you cannot own it. You can't own it below 120. And then of those two, JD's been the stronger one, FYI. So if we're above 70, target up near 100. Below 70, you can't own JD. Bottom line, you cannot own JD if you're below 70. Above that for a trade, again, you're buying garbage. Probabilities are not on your side. You have higher probabilities owning things that are already going up instead of trying to get cute and bottom fishing. And just as a reminder, this is not your father's emerging markets. This is emerging markets have changed. Back in 2004, technology was only 13% of EEM. Today it's 21. Back in the day, it had 12% energy. Today you have 4. So that's certainly changed. And then let's go over a couple of scans quick. Finish up with give the people what they want, JC. Nobody cares about your Brazil. Give them the stock, right? I got it. All right, so here, this is more international. So these are all the countries broken down. By the way, if send me an email if you're interested in the slides, and you can get that because I'm going to go pretty quickly. info@allstarcharts.com. Password: the trend is your friend. So these are all the countries around the world and their exposure to growth versus value. United States is number 2 in terms of growth exposure, behind only Taiwan. When people tell me commodities are not an asset class, I was like, all right, bro, commodities are not an asset class. This we're making 7-year highs, so you can ignore it if you want. Oil making new 7-year highs, CRB making new 7-year highs. And then here's Chevron, right? Chevron breaking out of a 7-year base. If we're above 130, I like Chevron long, target of 200. And you know what else I like? I like the January 2024 150 strike calls. So these are leaps 2 years out, January 2024, 150 strike calls. We got them for $12 last week. It answers the question, JC, do you want energy exposure, more energy exposure over the next 2 years? And my answer is a big fat yes. Do I necessarily want more energy exposure in the next 2 days or 2 weeks? No, not necessarily, but 2 years? Yes. So these are the young aristocrats. These are stocks that have raised their dividends every year for between 5 and 9 consecutive years. So for you old school homies out there that remember the dividend aristocrats, those are companies that have raised their dividends 25 straight years. Think Coca-Cola, Johnson & Johnson. But by the time that happens, you're probably not early in the cycle. So we're looking 5 to 9 consecutive years. Look at Conoco. If we're above 87, I like it long, target of 130. It's raised its dividend 5 straight years, pays 2.2%. Look at Cheniere Energy Partners. This is not LNG, which has also has been a monster for us. This is specifically their MLP. Pays a 5.4% yield, raised 5 straight years. If we're above 49, I like it long. Target up near 69. 69 on the target. And then Sun Life, it's an insurance stock, raised dividends 6 straight years, pays a 3.6% yield. If we're above that, those former highs, you're looking at about $60. I like it long, target up near 89. And then look at Stifel, 5 straight years of dividend growth, pays a buck, 1.5%. A lot of you are familiar with Stifel, sell side. If it's above 78, I like it long, target near 115. Under the hood, these are stocks showing an unusual increase in investor interest. Big volume coming in, chatter on the socials. We have a bunch of different scanners. We make a list. I like this one because it's both long and short. I like Arch Coal coming out of this list. Hot stock, if we're above 103, I like it long, target up near 153. And then I like this one short, Xylem, XYL, getting a lot of chatter. Only if it's below 89. If it's above 89, leave it alone. Below 89, I like it short, target near 76. And then this is our unusual option scan. We put it through some vigorous filters. We're looking for big splashes, big, very aggressive directional bets in the options market. And then we hand select them, right? Because just because there's a big action, any idiot can build a scan that shows unusual options activity. It's then going in there and hand selecting the best opportunities. Synovus, Energy, CVE, big action on the 17 calls. We're above 16 and a half. I like it long, target up near 25. And then Skyworks Solutions, buying the dip, big action on the 155 calls. These are the February 4, 155. Big action there. I like it long if we're above 125. Below 125, leave it alone with a target up near 200. And then boom, that's all I got. If you're interested in the slides, info@allstarcharts.com. And make sure to use it. If you don't send the password, you're going to get some random presentation. Password: the trend is your friend. That's all I got.
Holy cow. My mind is blown, JC. That is awesome.
Well, I appreciate that. I'm glad you. I mean, I could keep going. I could do this for another 3 hours. I mean, I got charts.
I know you could. I guess I have one kind of, and this, I don't know if this is a good question or not, but it's the first thing that I'm kind of curious about. CPI data comes out today, a little hotter than anticipated. You touched on interest rates. What's your
Mhm.
expectation? I've heard all kinds of different things. Some banks are saying 7 bumps this year. I've heard as low as 3. I've heard different percentage amounts. What's your anticipation? What are you expecting? What and how will those how will what you're expecting affect markets?
Yeah, I mean, it's not so much what the Fed's going to do. I'd follow tens. The Fed controls federal funds, which is one thing, but you're not a bank, so you shouldn't like. Investors are always so worried about like Fed funds, like those don't affect you. Like we want to look at tens. That's really the benchmark, and I think 3% is a lock. So what ends up happening, right? So the Fed controls the short end of the curve. So you're looking at ones and twos, for example, just skyrocketing, and their ones and twos are skyrocketing at a faster rate than 10. So when
Right,
you look at 2s 10 spreads and you're looking at the yield curve, you're getting flattened like a pancake,
right,
right? So when people are looking at that, they're wondering why that's happening. The reason that's happening is because the short end of the curve is moving faster than the long end of the curve, but it doesn't mean that the long end of the curve isn't going higher. So I think you could take 3% to the bank. You know, there's no evidence, and this isn't anything new, right? Like we've been talking about this forever. We've wanted to buy financials and energy stocks and stay away from growth forever because those are stocks that tend to do well in a rising rate environment. And we've been in the camp that rates are going higher because people are like all up in arms and their panties are in a bunch because of the CPI report. But I mean, oils and base metals and agriculture commodities have been telling you about this for years already. So like, it's not really been a secret. Remember, all this economic data is lagging, right? The prices of assets are forward looking. So if you're interested in inflation, like the CPI report is the last place you should be looking. I think you should be looking at the actual prices of those assets. So like by the time the CPI report, it's like, oh yeah, there's inflation. Oh yeah, no shit. You know what I'm saying? And then there's a reason why interest rates are doing what they're doing. So, the yield curve is flattening fast, literally crashing. And historically, stocks do well in that environment.
got it. Wow. Well, thank you again so much for being here, JC. That was such a great presentation. I really really enjoyed it a lot, and I really hope that I get to talk to you again here in the future.
Whenever you want. I mean, I'm here looking at charts. If I'm not talking to you about it, I'm talking to somebody else. So might as well be you. It's all good.
Next on the show today is the Red Dog, Scott Redler. Scott is the chief strategist at T3 Live and a frequent guest on CNBC, Bloomberg, and Fox Business. Today, Scott's going to be taking us on a deep dive into how he uses the EMAs, specifically the 8 and the 21 EMA, to determine trend. Scott, it's such a pleasure to have you on here today, man. I can't wait to dive into this with you.
Well, thanks for having me. I love going over this subject because I do feel like so many people always have opinions on where the market's going to go, how it looks, how it feels. But, typically that's an opinion. An opinion is an opinion until the market confirms it. And there's really no better way to then take the opinions out of the market by using what I'm going to go over here today. So I'm excited to present it.
Awesome. Well, let's get going, man. Let's dig in.
All right, then here you go. First thing you got to do is you got to look at the disclosure. So this way you can't hold me accountable for anything that I say. We all have big compliance departments. So there you go. So I know I only have a certain amount of time. I could probably go over this for an entire day. So I'm going to try and go through it pretty fast, and I'm sure you can watch it back. So, I like to go over trend analysis. It's really the backbone of my process. I believe everyone should have a process and a routine, and there are so many things that go into your process, but I would say the backbone of my process is trend analysis. So I use moving averages. A lot of people are like, oh, you're just a moving average guy. I'm like, I'm not just a moving average guy, but if you follow moving averages, you could measure the trend of the market. Okay, what is a moving average? Just because everyone who's watching this might have all different skill sets and knowledge base and experience. So a moving average is the average stock price over a certain number of days. Exponential gives a bigger weight to the most recent days. We only use exponential averages in this program. Some people use simple, some people use exponential. It's really like a zone. It doesn't really matter which one you use. You have to use what you're comfortable looking at. So this way, when you see what's in front of you, you understand what you're looking at versus not. So some people use a blend of an exponential and a simple. I like to simplify the whole process and just use one. So what I use every day, my bread and butter moving averages are the 8 and 21 day. They're the short-term trend, and that measures, to me, the active complexion of the market. If we're in a strong market and we're trending and you want to be in tons of names and have a lot of risk on, typically the S&P is above the 8 and 21 day moving average. Some look at the 50-day moving average. I like to use the 8 and 21 day because I'm an active trader. I do have all different time frames. I am also a long-term investor, but if you're an active trader and you make money P&L monthly and quarterly, I suggest you use the 8 and 21 day. So this way you know how much risk you could have on or how much off, and know how you could embrace volatility when we're below the 8 and 21 day moving average. Because if you're below the 8 and 21 day moving average and you're not long, when the market gets to the 50-day moving average, guess what you could do? You could test it, because sometimes you get a nice active trade there if you're not caught in it. Okay, that's the intermediate trend. Then you can go to the 200-day. The 200-day is the long-term trend. That's where institutions better step in and support the market or support whatever stock you're trading. And if it doesn't, chances are the institutional support's not there. It's in a downtrend. It's in a bear market, and you better avoid it. And just every now and then there could be a trade there, but it's not something you sit in. Typically, unfortunately, if you break your rules and you hold something that breaks below the 8 and 21 day, it turns into an investment versus a great active trade. And as an active trader, that's how you make money. That's how you make a living. So let's break this down just basically so you can see it. Right here is the 8 and 21 day moving average. This is a nice uptrend. It's following along. This is, what was this? This was, I think, the SPYs or the S&P cash. That's what an active, strong trend looks like, right? Higher highs and higher lows above the 8 day, sometimes coming into the 21 day, not even getting there. So this is a short-term active trend, the 8 and 21 day. Then here is when potentially there's a little bit more volatility. Here's your 8 and 21 day, and here's where it's following the 50 day, which is more of an intermediate trend. So for those who are less active, that might not trade fully for a living, but like to have money working, and they might have a job and say, I want to make cash flow besides actively trading as a professional. Since I can't be as active and watch the 8 and 21 day because you're not in front of a screen 10 to 12 hours a day, or for me, sometimes more, you give it more room to like the 50 day. So here is a trend that could follow the 50 day. Okay. And then lo and behold, here's your 200 day. So you have, if you're going to break the 8 day, like up here, right? And you get out of the way and you reduce your risk, you could try things at the 200 day. So basically here is a 200 day. So, the market and trends all test different moving averages. It all depends on where you want to live and how active you want to be, on which ones you follow. I tend to follow the 8 and 21 day moving average because I'm quick, I'm active, I'm in the process, I'm in the zone. So I could always get back in at a better time. For those of you who can't, then you have to figure out which moving average works for you. But overall, I think most should always know about moving averages, because you always want to have some flexibility and some cash on hand when markets go into corrective periods. So this way you could buy the dip when the market gives you the signals for that. So if you got out of the way here at the 8 and 21 day a little bit and reduced, just say you had 90% in equities, and here, we broke the 8 and 21 day, let me go to 60% in equities, then perhaps you put more back at the 200 day, and you then could be cute and make alpha or create alpha for yourself because you learned the lesson of moving averages. So I have two different trading approaches, which has kept me safe. It's kept me profitable, and it's kept me, in the game for 20 plus years, right? I think it's 22 years now. So I have a portfolio approach, right? So you hear about portfolio managers out there, these big billion-dollar funds. Well, you too could be a portfolio manager if you can understand the process of moving averages, meaning, it could be 4 positions for you. If you've been trading for a few years, it could be 8, it could be 15. At some point in the past 2-3 years, I've had 40 positions on. And those that follow me on the Alpha team or the VTF who came back to the market after the pandemic, like, Red Dog, you used to only have 6 to 8 positions on in the healthy market. I'm like, well, I've evolved. The more experience you have, the more your portfolio approach could evolve. But you have to measure your risk and know. So you have a portfolio approach again. It could be 2 positions. Maybe you take 0, and now you could take 2 with the best acting stocks that you like because you're in a market above the 8 and 21 day. So a portfolio approach means you're in a healthy tape above the 8 and 21 day. Leaders are breaking out. Usually tech and financials are probably really strong and you're having a great time, making money from the market trending and then using a tier system, which is another whole segment on how to add tier size to patterns as they trigger alongside the trend above the 8 and 21 day. I believe in the tier system. It's not all or none. And then you have tactical, right? Tactical, I start taking profits, especially in less strong names, and I possibly put on SPY as a hedge. So when I'm tactical, it means the market's probably not above the 8 and 21 day, and it means it's volatile, that it's not paying you to sit in things, it's paying you to trade things. And more or less, when volatility rises, the S&P and the Qs and whatever sector is below the 8 and 21 day. So if you want to see it on a slide, if the SPY is above the 8 and 21 day, I want to stay long with multiple stocks showing relative strength. Usually the leadership names closest to all-time highs, because I love trading stocks through all-time highs. It's one of my favorite patterns. In a portfolio approach, I rarely short. I don't fight the trend. A lot of people thought that Amazon or Tesla years ago were overvalued, and meanwhile, if they would have just not shorted it because it was above the 8 and 21 day, they would have saved themselves a lot of money. A lot of people had opinions on what a PE should be. As a trader or an active trader, you shouldn't have an opinion on what the PE of a stock should be. If it's above the 8 and 21 day, you just don't short it unless it's truly extended from it, maybe using your day count rule, which is another lesson. You have to focus on the price action, not the headlines. If the SPY breaks the 8 and 21 day, moving averages, I take profits, okay, and I clean up loose longs. Sometimes the first time it breaks the 8 and 21 day, I might have 25 positions on, and I can go to like 8 like that, and then figure out, was it just a break for a day? Was it something that gets below and stays below and shows continued weakness? And then maybe I go from 8 positions to 3 positions, and that's when I start adjusting around when things change. So when the SPY breaks the 8 and 21 day, I start getting out of things, and then I wait and see what's next. Like I said before, then maybe I test them at the 50, the 200 day, or I just trade tactically. When you're below the 8 and 21 day, kind of like what the S&P is now, right? It's February 14th. You want to be in tactical approach. You want to be looking for spots, compelling spots, not areas that are noisy, which is kind of like today, because we're not near the lows of January and we're not even oversold. The oscillator is like actually neutral, where on Thursday it was plus 60. All right. So again, some people are like, I have to be in long, I have to be in short. That's not true. Cash is a position. Some people said to me, if you have cash as a position with inflation at 7%, you're losing half your money in 7 years. I'm like, listen, we're active traders. Okay. Cash is a position during volatile times. You want to be in a position when things make sense, that you could jump fast and get in there and you could think clearly. And some people just aren't great shorts, and some people, you don't need to be in a sector that might not be comfortable. Everyone's like, you should be all in energy stocks because energy is trending. You could be in some because it is above the 8 and 21 day. But again, with geopolitics like we have now with Ukraine and Russia, maybe you don't want to have the volatility of sitting in energy names because they're above the 8 and 21 day. So you do what's comfortable for you, but always try and learn, so this way you can do more things and make more money when the time is right. So let me just show you real quickly what a strong stock looks like, because you saw what the sector is. Strong stock is above the 8 and 21 day. The sector should also be above the 8 and 21 day. And finding the relative strength within a sector above the 8 and 21 day usually is the best situation to go with, especially if you have limited capital. And ideally, the stocks I target are showing relative strength to everyone and that sector. So this is NVIDIA. NVIDIA, it's not now. This is a chart of the past when it was acting strong, and it was above the 8 and 21 day right here, held the 21 day right there, and then you had it trending above the 8 day, and boom, nice little breakout. So this is what a strong looks like, or a strong stock looks like when it's trending. And NVIDIA has been an active leader for multiple years, and typically there are great active sequences when NVIDIA is above the 8 and 21 day, showing strength where you could ride it in a portfolio approach and add share sizes around patterns, kind of like right here. So if you bought it when it held the 21 day and added to it when it got back above the 8 day, this was a nice breakable or tradable pattern to add cash flow for then a nice move. So that is a strong name. A lot of people went out of business shorting NVIDIA. When you short NVIDIA? When it's below the 8 and 21 day, not above it. Here's another strong stock. This was RBLX. This was when it was strong, and it changed, okay? Why was this a strong stock to me? Well, you had a gap up after earnings. Here's your earnings gap. It gapped up, let the 8-day catch up. Then it stayed above the 8-day and then took out the post-earnings high, and there's a nice move. Then when did it change? This is a red dog reversal sell where it gets above a prior high, comes back below it. Look at that engulfing move. That right there said the bears took the ball back, and that was your first signal that RBLX changed. But this is what a strong stock looks like. If it gaps above its earnings, holds the gap, holds the 8-day, has a nice move. And then you have to be on your toes when that active sequence changes. Then you have weak stocks, right? What are weak stocks? If I just said, strong stocks are above the 21-day, you have weak stocks that are below, like most of Kathy Wood's names for almost a year. So you don't want to try and buy a dip and catch a falling knife unless you do, quick little trades for cash flow when they're really oversold. But typically, when a stock is under the 21-day, it's in a weak trend. You're not trying to buy a dip. You're trying to buy a dip when they're above the 21-day. Then a weak stock is also probably in a weak sector. Okay, and anything under the 200-day is only for short-term trading. It's not sitting in. Typically that's a bear market. So moving averages work well if you want to short them. Also, stocks below the 21-day usually rally back to them and get rejected there versus supported there. So let's show this is Penn National. Everybody knows this stock very well. I'm not going to talk about Portnoy, but anyway, it was a winner for so many people 2 years ago. And then what happened? It broke the 21-day, okay, stayed below it, tried to poke its head above it, got back below it. And then here it was really staying below it. And then all of a sudden, it broke down. And then every time it went to the 8-day, it failed, and went to the 21-day, failed even more. And it was trending lower. I don't know how many people tried to get me to buy Penn because, you sold it at 85, you could buy it at 72, or you sold it at 72. Now you could buy it, here at whatever that was, 50s. And, we know Penn, I think it went below 30 recently or something like that, or maybe that was DraftKings. But both of them were in downtrends because they were below the 21-day. 2 years ago, you could look at it above the 21-day. That was when it was your time to be long them, not recently. Anyway, so that is what a weak stock looks like when it's below the 21-day, trending to the downside. Here's another one, DOCN. Remember, this was a high flyer also, and then it broke the 21-day right here with a huge engulfing down move. And then from there, what did it do? It rallied back to it and failed, rallied back to it and failed, rallied back into it and failed, all the way down to, 59. So again, stocks that are below the 21-day are not stocks you sit in. They're not swing trade longs. They're not close your eyes and hold your breath and go underwater. They are not owned for you. You could trade them with a red dog reversal. You could look, I could see a lot of different times where maybe you could make money for a day and a quarter, but you're not sitting in them as swing trades. So I like to put this whole process together and show you how you could have been either in portfolio approach or tactical approach based on the 21-day. And I'll tell you, most of my community had their best year in 2020. You know why? Because the S&P broke below the 21-day before Tom Hanks got COVID and the whole world woke up to it and we went off 35%. So let me show you how and break it down so you could see. So in the process of next time for next active sequence, you could either be long when we're back above the 21-day, or you could be out of the way when we're below. So let me give you the quick anatomy of 2020 where I could kind of put it together for you. I could do the anatomy if you want to look at some of my ebooks. I have an ebook on the 21-day and also shows another one on how I used it to navigate Tesla, which has been my number one P&L stock for the past 2-3 years. And then recently in the last year, done very well trading crypto because crypto uses moving averages and it trades so well, so clean, usually technically. And so I wanted to put it into a book together. If you want to, take a look at it, it's just on Bitcoin. It's free. It's a free ebook showing you how I use the 21-day. So I go over the anatomy of moves. I know it's hindsight, but you'll see how, oh my goodness, how come I didn't see that there? Oh my God, I could have just navigated it there and saved myself so much money. So next time you're in the moment, you'll listen to your inner voice that tells you what to do when it's actually in the moment of doing it. So let's get to it. S&P 2020 case study, what to watch. The market operates in a series of active sequences. That's how I like to live my life, in active sequences. how to understand the complexion of the environment is key, and to see potential areas to put risk on and risk off. That's what we are. We're small little PMs right now. We want to put our money to work when the market's strong, when the S&P is above the 821 day. We want to ride things in a portfolio approach, but when it's not, we're out of the way. Cash is a position. Maybe if you're a good short, you short things. If you're not, you just look for compelling spots. So, by the way, so this was on Twitter. This was January 22nd of 2020. Okay, I am not fear-mongering, but a few of my friends in China say the numbers of those affected with the coronavirus are in the thousands, not the hundreds. But their government is trying to keep it quiet. That was January. That was 12/28 on January 22nd. That was right here. That was before, the market technically gave you reasons to get out of the way. The only reason why I said that is, again, I try and use all my resources. I've been doing this for 22 plus years. I have people on the Alpha team. I have them in the Redler Report. I have 100 friends I forward my note to that are in every different type of financial firm across the board, hedge funds, this and that. And I had some guy just got who's supposed to go to China for the lunar holiday. And his dad said, "You are not allowed to come to China. There is COVID and Corona everywhere." And he said to me, and basically that. And I was like, okay, let me just throw it out there. I throw out there anything that I think is compelling for somebody that could help them. So here is where, that was tweet happened. So some people could have said, maybe got short there, and all of a sudden makes a little bit of a move. Red Dog, you said that the China's hiding the statistics. Well, the market didn't tell you that the world cared yet. Maybe it wasn't loud enough. So let's go through a breakdown of how you could have navigated, because I did this day by day trading and on Twitter. So you go to the next thing right here. Okay, let me show you. This gap down. I don't know if you guys remember it. First of all, it gapped down when we were below the 8 and 21 days. So this is when the S&P finally rolled over a little bit. So we were below the 8 and 21 day. Then all of a sudden you gap down. Okay, so hopefully you were already reduced your risk, because if you look like kind of in a microscope there, we were already below the 8 and 21 day. Now you gap down below the 50 day. And right here was a prior level. I remember it very well. And we shouldn't be showing you this one yet for dramatics. But basically, that was when you could have taken all the risk off. Right there. Even if you missed the first 2 days of it. Then, you had your first move lower, came back into the moving averages. So now you lost the 8 and 21 day and the 50 day, and now you finally lost the 200 day. Sometimes you break below a 200 day and then you come back and retest it. If you can't get back above it, chances are there's no appetite for risk. So then what happened? Downside follow through. Oh, this was actually when Tom Hanks came out. And I remember that was a scary day in the whole pandemic. Everyone's like, oh my God, Tom Hanks can get it. And I think that's when they halted the NBA. But from here, you were below the 821 day this entire time. And I think at this point, I don't even know how much off the highs we were. We were probably like only like 15, 20%. And then look, from when Tom Hanks got COVID and below the 8 day, went all the way down 35%. So if you would have got out of the market and got out of your portfolio approach and got tactical so you could embrace risk, you were able to navigate it pretty well, short or just in cash. And that was during this entire process. We were below the 8 day the entire time until finally down 35%. And when we were down about 15%, I started putting my blood on the street account to work, which is a whole nother situation and story for long term. But anyway, then from here, okay, you had your first bounce back, and we took back the 8 day, right? You took back the 8 day for the first time. So even if you didn't catch the low or didn't buy versus gap, now you're like, okay, we just got above the 8 day. Maybe now we could put some risk on if we hold above the 8 day. And then, so you did come back, getting above the 8 and 21 day on this, on that. Sometimes they call that the cross. But I was pretty much back in the market right around here on this big gap up. And then I would say probably into the test of the 21 day, maybe I got a little lighter. And then here you had a higher low. And then this is when we cleared this spot. Okay. And then what's important is everyone, if you do remember, I remember right around that spot is when everybody came out and said, now we have to test the lows. Now we have to go back and test the lows, the COVID lows. Every billionaire hedge fund was like, we got to go test the lows. And then they would say, well, I'm invested, but you shouldn't be invested. But meanwhile, from this spot on was a spot when a lot of people lost a lot of money because you had this oversold bounce and nobody thought could continue. But what happened was we were above the 8 and 21 day. So the opinion of, we have to go back and test the lows was just an opinion because the market never confirmed it. So moving along, you had this pretty aggressive move to the upside, and then you gap down. What do we do here? This was like a red dog reversal long. This was where we had that prior breakout and it held, and then PS. This was when actually I don't know if you guys remember when Apple and Tesla, that was over the summer, I think. Yeah, they announced their stock splits, which re-energized the market. That's when people are like, oh, well, stock split don't matter. I'm like, yeah, they do. Apple, Tesla split, and they wound up being up a lot more than Amazon in the last 14 months. Why? Amazon didn't split. But anyway, that's a whole nother conversation too. But anyway, you have to know what's leading what. And at that point, tech was leading. And then I continued all the way up. So right here, when everyone's talking about retesting the lows, did we retest the lows? So a lot of people losing a lot of money short. And then I remember this was, I think, September something or other, where you had that big wide range bar and tech ended the rally there. And then money switched gears. I think money from there then wound up going to the financials and energy. We always have to know what's leading what. And then the rally ignited again here above the 21 day, and then another active sequence. And this was also the double bottom of the election. So you could put together a lot of different type of technical things here. I wanted to just give you really the broad base, which is the 8 and 21 day. When you're above the 8 and 21 day, you try and be long things. And then there's different sectors that lead. This was when Apple and Tesla led the market with tech. And then I do think this one was where kind of like energy and the banks took over, which made it a little bit harder because tech wasn't as strong. But either way, this whole snapshot, was all active sequences, and you could have been risk on above the 8 and 21 day, risk off below. And sometimes, you break the 8 and 21 day, you get out of some risk. People are like, oh, I just got out of some risk, and then it gets back above it, and you have a worse price, but who cares? You took a paper cut. You get out of the way, because sometimes you get out of the way and look at what you could save yourself here, and that's how you get out of the way when a corrective phase starts. And some people are like, well, this isn't going to end well. I'm like, okay, this isn't going to end well. Isn't it a trading strategy? If we get below the 8 and 21 day, maybe it's not going to end well. Because in order to go down 10% from the highs, what's the first thing you have to do? Get below and stay below the 8 and 21 day. Then the 50 day, then the 200 day, then maybe it could be down 10%. Okay, then you see what type of rally we have back to see whether or not you make another leg of that. So in conclusion, moving averages tell you the strength and weakness of trends. Focus on stocks and ETFs with real trends you can ride, and ignore the noise, because there's so much noise out there in the market. There's so many opinions out there in the market. If you use your moving averages and you look at relative strength and you look at the sector rotation, you could always keep yourself at least in a position where you're not going to blow yourself up, because you know how the market's feeling, what's in play, what's real, not what's hype. And by watching the moving averages, it'll always tell you what type of composure we're in. And sometimes it's choppier than others, but when you find a great active sequence you could ride and you're in a good portfolio approach, you can make a year. Most traders make the year 3 months out of 12. Because why? They're in strong active sequences to the upside, or maybe even to the downside. Then the other months, you just have to make sure you're not over trading. You have to make sure you're disciplined, make a little bit of money, and not give it back when you're in a trend that makes more sense with continuity and momentum. And that's your simple trend analysis.
Awesome, man. Awesome. So I've got a couple of questions for you. You mentioned COVID lows. You're in on that big gap up, that first big gap up day. That's kind of before we start seeing really like a change of trend with the 8 and the 21, right? Like, is there a particular place where you will find yourself starting to add risk? Are you approaching it like as soon as price is able to find its way back above the 8? Are we looking for price above the 21? Are we looking for the 8 above the 21? Like, I understand that there's probably different people have different risk profiles. So, you may feel really comfortable jumping in right when price gets back above the 8. Another trader may feel more comfortable jumping in once maybe the 8's above the 21 or price is above both of them or something like that, right? Like, is there a particular scenario that you found you prefer?
That's a great question. A lot of people want confirmation, or sometimes people want over confirmation. By that point, you're already had a nice move, and then you have to actually wait for it to digest. If you look back down here, sometimes when you get so extended below the 8 day, you have to put some risk on. Or sometimes when the oscillator, I talk about the oscillator a lot, when the McClellan oscillator is minus 40, or my proprietary oscillators, I oversold at minus 40 and it's minus 100. Down here, I remember it was like minus 100. It's like a gas oil slick where you put a match on it and you're going to fry up the shorts. So sometimes I'm like, hey, this is a tricky long, but I wouldn't press shorts. So that's when you're starting to look at things. That's when you're starting to look for little signals. Maybe down here, the key stocks like a Google or an Amazon or an Apple weren't making new lows. So they were diverging from the S&P, making new lows. So that's a signal also. And not every trend change is different. Some are really extreme and some are kind of subtle. So it all depends, like the world we're living in at the time. As of right now, we're kind of in this volatile world now too, where you had the S&P came off 10% from the highs, NASDAQ came off like 15% plus. But then if you think about 2018, when the Fed had to reduce the accommodation, and raise rates, in 2018, the S&P was off 20% in 3 months, and the NASDAQ was 24%. So we've only been 10% off the highs, and we just had a 3-year move where we were up 100%. So historically, you're up 7% over 100 years. We were just up 100% in 3 years with massive stimulus. So in my head, I'm like, hey, I'm going to be a little bit more careful here, because chances are we're 6 weeks into the Fed just talking about reducing all the pace of purchase before raising rates. Things could be a little dicey. So I'm going to respect levels and maybe be a bit more careful. But down here at the bottom of this 35% off the highs with an oscillator minus 100, I think I was like selling SPY puts at the time, selling Q puts at the time, and then having a gap up like this, you kind of you're acting a little differently than maybe this pullback, this gap, this pullback. But if you look at this pullback right here, if you could see it, you could see the chart.
Yeah.
You had a red dog reversal. A red dog reversal is when you pull back, you go below a prior low, come back above it. So that red dog reversal gave me maybe some thoughts to get some longs on before it took back the 8-day right there. So it's a blend. Your whole process is a blend. It's a blend of what's happening in the world, where your risk tolerance is, what your time frame is, what's leading what. And back here, this was a crazy time period. But when you're above the 21 day and things are just smoother, you don't want to fight it. You want to, and then it's an easier time period. The market can make you money. As of right now, we're below the 21 day. I think we're testing we're just going back and forth with the 200 day. You want to be in a very tactical approach until finally, hey, you get to a compelling area that you want to test. Which we remember we had that low. What was it, January 26th? That was also with the red dog reversal. That was, I put on a bunch of longs. Well, we were well below the 21 day, but I wasn't looking for a trend type of portfolio approach trade. I was looking for an oversold bounce into a very oversold oscillator with the S&P triggering computers down 10%. So it made sense. So sometimes it's tactical trades, and you could be long even though you're not above the 21 day, but you have to know the type of trade you're looking for. And then sometimes when you reclaim it, then you watch and measure a new active sequence build. And sometimes it goes for a week only. Sometimes it goes for 3 or 4 weeks. So all of a sudden, sometimes you turn around at 6 weeks and you just made a lot of money riding the strongest stocks in the market, using a tier system to net money along the way with your chart patterns, and then hedging at times when things get a little bit overbought.
Got it. What about time frames? You focus here on the daily, right? Do you ever use these moving averages, these exact same ones, the 8 and the 21, on different time frames? If you were day trade, scalping, I don't know, scalping weekly options or something like that, could you utilize these moving averages the same way?
Yeah, you could. If you usually when the day starts, I write down all my pivots from the daily charts because they usually mean more. Then when the day starts trading, I have a bunch of different windows up. I have a 3-minute chart, a 5-minute chart, a 15, and a 60. And then I change the time frames a little bit throughout the course of the day. So if all of a sudden, you want to ride a trend of the day and you're day trading because you're tactical, because you're not in a lot of risk, like today, the SPY was above the 8-day and the 21-day for a little bit, and so were the Qs up until midday. They broke them, and that could have been your stop on your active trade for the day. Which I know we were talking about before. Like I made a lot of money in the SPYs today. I made my money in the Qs because the Qs were stronger than the SPYs, and they did a reversal, and most of the FANG names were up, and then the SPYs followed the Qs. And then I went back to the Qs midday because I thought, hey, maybe the trend would continue. We just had a down move, and you heard all the headlines and the jawboning about whether we're going to invade Ukraine or not, blah, blah, blah. So I never went back to the SPYs, and that's where I made my money today. And initially I made my money in the Qs because it was stronger, and then there was no muscle memory. But you can use the 8 and 21 day on a 3-minute chart, a 5-minute chart, a 15-minute chart. 2 weeks ago, I started to look at the moving averages of the weekly and the monthly charts because we were breaking all the daily levels, and I wanted to get points of references from the past prior years. So I didn't start buying things into noisy no man land levels. I wanted to look at where the moving averages were and which ones were broken back in 2018 to think about the similar chart patterns and sequences. So it all depends again on the moment, but you can use the 8 and 21 day on an intraday chart, and it will tell you when the trend that you're using then changes. It can measure any time frame.
Awesome. Right on, Scott. Well, this has been great. I really enjoyed this presentation. I'm definitely going to start paying attention to these moving averages now. Yeah,
listen, we all evolve and we all learn. There's a lot of things to use, and then at times when all of them come to a head, and that's when you swing the bat harder, and that's when you try and make more money. When all your time frames line up and a lot of indicators line up, boom. But then a lot of the time that's not the case, and you just have to massage the sequence and the trend and try and stay with it until it changes. But what the most important thing is realizing when it does, and also being aware when it feels like it, before it happens.
Right.
Both ways.
Right. Well, again, thank you so much for being here today. We really appreciate it, and can't wait to talk to you again in the future.
Well, thanks for having me, and I look forward to it. Good luck to everybody.
Cheers, Scott. Our next guest today is Bob Desmond. Bob is the CEO of Contrarian Trader, and today he's going to be taking a deep dive into the correlation between CPI and Bitcoin. Now, Bob, I understand you think that Bitcoin traders might be sniffing out something that the rest of the market hasn't quite yet caught on to. I'm excited to hear your thoughts on this.
Yeah, Jason, thank you so much. And there are many myths out there about whether or not Bitcoin has a correlation to anything. And that, the CPI is one economic index that we can track and say, okay, with pretty much absolute certainty that Bitcoin has a correlation too. And we're going to go to the reasons why of late that correlation might not have planned out. So we're going to go with the short-term analysis of what might be happening with Bitcoin and a longer-term bull case for why Bitcoin and the CPI are going to rally for the longer term. And in fact, if you stick around to the end, what I'm going to do is I'm going to talk to you about a short play of Bitcoin using options and or short selling a stock that'll get you short of Bitcoin without ever having to touch Bitcoin. So let's get to it. I just want to talk a little bit about who the heck I am. So a little bit about me. I live in New York, married, 2 kids, 2 dogs. I've traded equities and options for about 27 years now. I founded the Contrarian Trader back in 2005. And primarily my style is as an equity swing trader with a set of longer term core positions. And since April of 2021, we reduced our risk exposure by switching more to options trading for many variables, one primarily being the valuation of the market, 2, the technically overbought situation we found in primarily the IWM, and which is a small cap ETF, and the triple Qs. By selling options, we are the casino and not the gambler. We rarely buy options. So by doing so, by selling those options, it allows us to generate a higher probability of profit and consistent cash flow with lower risk. So some FAQs, strategy-wise. When do I trade trending markets? We use multi-time frame analysis. So once we get a confirmation on, at a minimum, weekly and daily time frame, and ideally monthly, weekly, daily time frame, we will either go long or short depending upon the Federal Reserve. What's their stance? Is it a hawkish stance, neutral stance, dovish stance? And we'll trade that direction. When do I leave the markets? Technically overbought conditions primarily. We use the charts. TrendSpider is a great partner for helping me get in and out. They've been invaluable over the years. Overly bullish sentiment, particularly on the part of the small new investor. We've seen a lot of that over the past year and a half. And of course, Fed policy. When do I predict a market change? It's a rules-based approach, and TrendSpider, it sounds like a plug, but it's not. It's the truth. We use their trade alerts. And I'll show you where those trade alerts would have helped you out on a monthly chart on the buy and on the sell of Bitcoin by taking a look at TrendSpider. So I'm going to skip over to the monthly chart of Bitcoin to just do a real quick hindsight review of where we've been and where we might be going. Okay, so what we're looking at here is a chart, a monthly chart. We always want to take that higher level view. And frankly, what got me connected with TrendSpider from the outset was their appreciation of multi-time frame analysis, basically appreciating what should be happening on a weekly or monthly time frame before you make a decision on a trade on a daily time frame. And they put into the program what was going on into my head, and I said, wow, that clicked. So ever since, I don't know, 2017, Dan, Jake, and I have been, and team have been working together. So great product. Anyway, if you were using a rules-based approach, as I just mentioned, you're using the automated trend lines, you would have got a buy signal way back here, July of 2017, rally, and on this topping action above the third standard deviation Bollinger Band, you would have been out of this trade and you would have avoided this pullback. But then again, back here in March, and if you missed this signal, which is understandable, back here in April of 2019, you got another buy signal on Bitcoin. If you didn't get in there, that's fine. You got a higher low here and then a continuation breakout in April of 2020, and you would have enjoyed this ride up higher. When would you have gotten out of this trade using the automated trend lines on TrendSpider? Right here, the computer, the technology, the algorithm does the work for you. You would have had an alert set, touch, bounce, and you could have exited on the alert out of this trade and profited and avoided this pullback. And you would have gotten a second alert at this upper band of resistance as well. So I'm going to come back to this chart if we have time later on to illustrate where we might be going on a daily, weekly, monthly time frame. In this case here, you have Bitcoin, which has a clear and defined correlation with, as you can see here, the CPI, the Consumer Price Index. What is the Consumer Price Index? That is a benchmark for the measure of inflation at the consumer level. And the CPI comes out, it's reported once per month and can have a big impact on the market if it comes out very, very hot. So overlaid here in gray line above, we have Bitcoin versus the CPI. And you could see that there is a clear and distinct correlation. In fact, they traded with a correlation on a monthly time frame at nearly 87% back in April of 2021. At current, there's still a very tight correlation. It's undeniable, correlating at about 75% of the times. So when you hear somebody saying to you that Bitcoin is a trading vehicle unto itself with no correlation to anything else, that's not true. Bitcoin is, in fact, a hedge against inflation. So with that, you may be asking, why has Bitcoin of late gone down so dramatically while the CPI, while inflation is ripping through the roof? We're going to address that. Stick around. Moving on. So when I first found out about this correlation, I said, you know what, let me validate this. I don't want to rely simply upon the CPI. So when I saw the correlation on the CPI, I said, you know what, let me move on over and validate what I'm seeing here using the Prings Inflation Index. And that's reflected here in brown. And you could see that they pretty much go lockstep in hand. And the correlation of the Prings Inflation Index, while it's nowhere near where it was at its high, just like the CPI back in April, it's come in some, but there's still a clear and defined correlation. And you can see this curve has declined rapidly of late. Why? It's because of the fear of the Federal Reserve aggressively raising interest rates and fighting inflation. So when you're seeing Bitcoin pull back right now, despite rising inflation, it's only because the markets believe that the Federal Reserve is actually going to fight inflation. And I'm going to show you in a moment that they're not. So let's move on. Before we move on to my argument as to the bull case, bear case, and why the Federal Reserve is not going to be able to fight inflation, I want to point out something. There's another correlation here, and that correlation is with the triple Qs or the S&P 500, but the S&P 500 is not as vulnerable to the sell-off as are the triple Qs. Why? They're more overvalued. So I'm more worried about a rollover in big tech right now than I am on your oil stocks. They're outperforming. On your transport stocks, they've corrected, but they're bottoming out right now. And the transports, as they may be bottoming out right now. So you can see here, monthly chart, triple Qs. What we have is a very strong correlation. That's correlated with Bitcoin 79% of the time. So what do you read out of this? What you read out of it is that there is a correlation because both are risk assets. It is a risk-on environment of late these past couple of years, so the two have traded in tandem. What could cause these two to break, or in another word, diverge? Let's talk about a short-term bear thesis and address the possible divergence of Bitcoin and the trip Qs. Comes down to this, folks. It's the fear of rate hikes. You have bank analyst predictions that in 2022, Bank of America, they're predicting 7 rate hikes. Goldman Sachs, 4 rate hikes. JP Morgan, I have there in parentheses Jamie Dimon, he says 7 rate hikes, despite the fact that his own economic people say there's only going to be 4, maybe 5 rate hikes. He vetoed them and said 7 on CNBC, I believe. The short-term conclusion, the Fed will continue to drive sentiment. That's not going to change anytime soon. Sentiment, of course, is always going to drive the markets. Inflation remains very high with the Fed having done nothing. We are talking about inflation in the U.S. economy for nearly a year now. Yet what has the Federal Reserve done? The Federal Reserve continues to build its balance sheet. They continue to throw gasoline on the inflation fire. The number of banks issuing dire aggressive rate hike forecasts leads us to believe and conclude that they are net short of this market. The Bank of America announcement has only come out in the recent days. So when I heard that Goldman Sachs and JP Morgan about the same time came out and issued these dire forecasts for rate cuts. So when I heard that JP Morgan and Goldman Sachs issued very aggressive rate hike forecast for 2022, I went to my members and I said, get ready. They're going to sell this market off. They're positioned short of this market. And sure enough, a few days later, it all rolled over. What are our other short-term concerns here? We still have record high margin debt. So if we do begin to break down to new lower lows after putting in a lower high in this market, you're going to see forced liquidation of equities. And if necessary, you're going to see people sell their Bitcoin to raise capital. And they'll also sell Bitcoin out of fear. Why else might there be a sell-off? Valuations remain historically high. And a risk-off environment and a continuation move lower will cause Bitcoin to fall with the trip Qs names, as they are 75% correlated on a monthly time frame. That was a little bit depressing, but there's a trade to be had to the short term, excuse me, but there's a trade to be had should we see a rollover on Bitcoin. Stick around to the end and I'm going to go over it. So what's the longer term bull thesis on Bitcoin? So we're going to go back to JP Morgan. We're going to go back to their forecast for 7 rate hikes, and that was repeated by Bank of America. So let's do the math. Let's take a step back, do the math. 7 rate hikes at a quarter percentage point each. That's a rise of interest rates by the end of 2022 at 1.75%. The current 10-year yield is at 1.96%. Total year-end 10-year yield, assuming they follow through with all these rate hikes, which I deem highly improbable. We'll talk about that more in a moment. Year-end 10-year yield, 3.71%. What's the reality? 10-year yield, 3.71%. The reality is this. The only known that we have is we know that CPI is at 7%. We may possibly, far stretch, have a 10-year yield at 3.71%. So what's the net effect on the 10-year yield? You're getting a negative payment of 3.29% in real terms adjusted for inflation. That's the reality. That's assuming worst case scenario, 7 rate hikes in 2022. Here's a chart of inflation in the United States, clear and defined. Not arguable. This is fact. Everything else is speculation about what the Federal Reserve is going to do. At current, we're at 7%. Here's the Federal Reserve's balance sheet. The balance sheet is at all-time record highs. They announced taper back in November of 2021. In February, as we're recording this, we are at all-time record highs. So let's draw an analogy here. Your house is on fire. The fire is inflation. The Federal Reserve drives up in a fire truck. They take out their hoses, and what are they doing? They're shooting gasoline in lieu of water onto the fire. They're not serious about inflation. So what's the bull case for Bitcoin here? How does this help Bitcoin? Well, remember the fact that the correlation between the CPI and Bitcoin broke down. It hit a peak in April of 2021. Currently still sitting around 75%, but it's declining. Why? It's a fear that the Federal Reserve is going to aggressively fight interest rates, but they have shown no willingness whatsoever. And in fact, they're making the case worse by buying more debt. So what happens when Bitcoin traders wake up and they realize, holy cow, these guys are not serious and inflation is out of control? Let's talk about it. With CPI at highs not seen since 1980, the Fed continues to throw gasoline on the inflation fire. I could repeat that all day long. Even with 7 rate hikes in 2022, real rates remain negative, with CPI possibly slowing, but still growing. We have 30 trillion of US debt, which caps the amount that the Fed can raise rates. Why? The normalization of the 10-year yield to, let's say, 5.5%, going back historically, the interest payments alone, forget about the principal, the interest payments alone on a yearly basis would be the equivalent of the defense budget. There is no way on God's green earth that they could possibly normalize interest rates with $30 trillion in debt. Add to that the yield curve, which is the spread between 2-year and 10-year Treasury yields, it's declining. 9 of the past recessions have been signaled in advance by an inverted yield curve, meaning you're getting paid more for a 2-year Treasury bond than you are for a 10-year Treasury bond because people are too afraid to lend out 30 years. They'll only go out 2 years. What else? What's the other reason why the Federal Reserve is not serious about raising rates? Midterm elections, folks. Fed Chair Powell has not yet been reappointed by the Senate, reaffirmed by the Senate. His job still hangs in limbo, and he wants that job. And if you have a stock market which is crashing, the Democrats are already in trouble. If you have the stock market crashing and 401ks collapsing as well, well, then you're going to have Democratic Armageddon. Just to wrap it up. When Bitcoin traders realize the Federal Reserve is not serious about fighting inflation, the US dollar will correct hard. Commodities are going to rip up higher. They're already moving up higher. Gold's going to rip up higher. It too is moving up higher, finally breaking out of a base. Capital flight out of the US will go into commodities, international value stocks, and yes, Bitcoin. It'll drive Bitcoin a lot higher. Let's do a top-down approach on Bitcoin from where we are at current. Because remember, I have a short-term bear thesis on Bitcoin, and for the only reason is because I don't think yet that traders appreciate the fact that the Federal Reserve is not serious about raising rates. We've shown the correlation between the CPI and Bitcoin. They trade lockstep. The only reason why Bitcoin is selling off hard at current, or has sold off hard recently, despite rising inflation, is fear, a risk-off environment, and two, Bitcoin traders are concerned about the Federal Reserve actually being serious and getting inflation under control. Because if the CPI rolls over and there's a correlation of Bitcoin, what happens to Bitcoin? It's going to roll over as well. I don't think that's going to happen. So let's talk about the macro view of Bitcoin. Let's face it, this is a heck of a run here. Gorgeous run. It is not done. We are still in an uptrend channel. We still may, and that's a capital may there, we may continue up higher, but a couple of things are bothering me here. Monthly Stokes, lower highs. The month is not over yet, so this could change. Maybe we'll hook back up, but I doubt it, because this includes January now. It's asking a lot to have these hook up right now because we're putting in lower highs and now potentially lower lows. As you can see here, we have broken down this month below the lows of January. This month is not over. We could bounce back. So this is not in the books yet, as I like to say. Weekly chart. So on a weekly time frame, at the time of this recording, Bitcoin's been under some pressure. It's bounced back for the past few days. But what I wanted to point out here is that we have, let's take the heat maps off for a moment. What we have is a potential head and shoulders setup. Left shoulder, head, right shoulder. And we could use this as our neckline, this line here in green, where if it breaks, we're going to have a continuation breakdown on Bitcoin. That's the short-term concern that I have technically. And psychologically as well, we have a March Fed meeting coming up. That's going to cause a lot of volatility. Daily view. Now, the daily view, we've had a strong week thus far. We're looking okay. My concern is that we are nearing resistance at around 46,666. So we may struggle there. That doesn't mean we're going to roll over and break down by any stretch of the imagination, but it's a cause for concern. If I were to ask, hey, listen, would I buy it here right now? No, I wouldn't. If we broke out above resistance, I would certainly entertain it, but not right now. So what if Bitcoin does in fact break down? What's the trade? What's the trade here? Especially if you want to trade options. How are you going to trade options on Bitcoin? Well, there's a way. So our Bitcoin short strategy, and this is extremely short-term speculation, folks, and it may never, ever be a trade that we put on because it just doesn't set up properly. Now, Bitcoin's recent sell-off, let's do a quick recap. Hawkish Fed rhetoric, Wall Street Bank's aggressive rate hike forecast, CPI 7% annualized inflation rate, PCE, that's the Federal Reserve's favorite inflation gauge, is far exceeding their 2% threshold. Why does that matter? Well, concern about an aggressive Federal Reserve, but we've kind of already addressed that, the reasons why I don't believe that the Federal Reserve is going to fight inflation aggressively. They can't. We're bankrupt. And plus, you have an election year coming up. So the result, risk off for stocks and Bitcoin if the market sentiment changes bearish yet again. Where we are on a relative basis, nothing has changed from the recent slide that I just showed you, this one here. CPI is coming out on February the 11th. Market valuation remains elevated. This is the dot-com bubble. Many of you out there were not old enough for trading, maybe even alive when the dot-com bubble burst. I was trading it. And the phrase, the adage, the markets take an escalator up and an elevator down was best learned during that massive, massive bear market. Here we are now. We're not up to where we were back then, but back then we didn't have 30 trillion in debt. But we are certainly, in terms of valuation, I shouldn't have said that. This is a valuation, Schiller PE ratio model. We are knocking at the door of the 2000 bubble, and we are rolling over. So moving on to what the trade would be if Bitcoin does in fact roll over again, short term, longer term bullish. Enter Michael Saylor, CEO, MicroStrategy. As of December 29th of 2021, MicroStrategy, this is off a CoinDesk, MicroStrategy had 124,391 Bitcoins, which they leveraged up on. They borrowed it. Basis cost, $30,159 per coin. Here's the correlation of Bitcoin to MicroStrategy. They have an 89% correlation on a monthly time frame. That's a greater correlation than CPI, the triple Qs, and the Pringles Inflation Index. If Bitcoin rolls over, so goes MicroStrategy. The Rubicon. And this is where MicroStrategy comes into all sorts of trouble. Remember that their basis cost is roughly about 30,000. So with MicroStrategy leveraged up on Bitcoin with a basis cost of 30,000, a close below that mark on Bitcoin would be a technical, psychological disaster for MicroStrategy. And Lord knows what kind of covenants that would trigger within the organization and their lenders. So what's the trade here? You could short the common stock, but there are problems with that. You know, we're in the business of risk first, making money second. So the upside potential for shorting the common stock of MicroStrategy is that you have theoretical unlimited upside potential. The downside, you have unlimited risk. And a volatile underlying derivative being Bitcoin, which trades 24/7. So if you go home short of MicroStrategy, you have bullish news that comes out on a Friday evening, and you're watching Bitcoin rip up higher over the weekend, you have a bunch of new gray hairs by Monday morning. So this is not the strategy I would suggest that anyone take with the speculation that we're doing here. I think that the trade that I prefer far more is a bear put spread, also known as a debit spread, where you're buying it in the money put option, a 70 delta, basically meaning that for every dollar that MicroStrategy moves, the option moves 70 cents. And simultaneously, as you buy that put option, the 70 delta, you sell a 30 delta out of the money. What does that do? Well, it helps you finance the trade. And if you're wrong, in the short term anyway, because you're not going to buy a 30-day or a 45-day option, you're going to want to buy a 60-day, 90-day option. So you can afford to be wrong for a while and let that option on the 30 delta work for you. And if you get enough time to you can even take that off if you'd like to, if you see a good setup and you're very confident that MicroStrategy is going to break down. Either way, it's a hedge. on that long option position. So what's the upside? You have defined risk. I should have put a D at the end of defined, but okay. Sorry about that. You know immediately what your max loss will be. So that Friday afternoon news comes out, Bitcoin skyrockets, you know exactly what you're going to lose. What's the downside? The only downside here is that you limit your upside potential. So let's say that Bitcoin breaks down below 30,000, 25,000. You're going to miss out on some of that upside potential while you short of the common shares, or if you were just simply long of the puts with no hedge on. So that's the only negative to that trade, and that's a trade I would take. So that's my take, guys.
So, okay, no, that's really fascinating stuff. I guess my first question for you is regarding rate hikes. You know, you're saying 7 is completely out the window. That's not happening. What is a realistic number that you actually might be looking for? What are you anticipating?
Well, what I don't think it's going to happen. I think that we're probably going to get 2, maybe 3 market buckles. Midterm elections come up, the phones start ringing from the White House down to the Federal Reserve. You got to stop this. The stocks are crashing. Can't get it off the news. So it's not that it's impossible for them to raise interest rates 7 times, but here's the outcome, right? And I'll bring you back to this slide here. Even if they did raise interest rates 7 times, the reality is you still have negative yields with inflation rising roughly 7% of the time. Excuse me, roughly 7% annualized, the appropriate way to put it. So inflation is far outpacing the rate hikes. Now, Paul Volcker got that back in the 1980s, and he raised rates very, very aggressively. But we were a creditor nation back then. We're a debtor nation now. We have $30 trillion of debt. We had a token amount of debt back then. To normalize rates right now is it can't be done.
Gotcha.
Can't be done.
So what's your time frame looking like for this Bitcoin trade, this downside Bitcoin trade? Where do you
It's fairly, yeah, it's a good question. It goes back to this. I mentioned this from the outset, is that it's a rules-based approach. Bitcoin needs to break down, or it needs to rally up into a stiff resistance level. I'm using a daily chart. I really shouldn't, but I'll use it for illustrative purposes. If we rally up to around 49,000, that just assumes we get past 46.6. But if we rally up into those resistance levels, then we begin to roll over and break down, I would begin to entertain opening up a short position of MicroStrategy. The only time that I would put that trade on for real, though, heavy, is if we broke down to new lower lows versus the lows of January, because then we have a confirmation continuation breakdown, and then I'm more confident, okay, the path of least resistance is working in my favor, therefore I can lean into the trade with confidence.
right?
But I would still only go with a defined risk trade. Because I always worry about being short over the weekend, and God forbid you're short over the weekend, news comes out on a Sunday. How many times have you seen Bitcoins moving in one direction or the other over a weekend?
For sure. I've definitely been in that trade before. Do you have a tentative time frame outlook for something like this, or is just kind of we're just waiting to see? We're either going to break to the upside once we get up over that 46, 49K level, or we're going to roll over there and we'll see what happens when we come back.
I think if we break
previous lows.
Yeah, I think if we break out above 49,000, this trade thesis is off the table. But I think first, before we say, okay, let's take it off the table, we need to first wait for that breakout to occur. that certainly minimized the probability of that rollover occurring, because now we're starting to put in higher lows and higher highs. And the key event that needs to take place, of course, is the Fed meeting, and how traders deem that rate hike. Is it a half point? Is it a quarter point? There's going to be a lot of anxiety leading up to that announcement. And it's also going to matter what Powell says about their policy moving forward. What's that forward-looking guidance going to look like for the markets? Is it going to be risk on or risk off? So with that tight correlation between the triple Qs and Bitcoin, well, I think if Bitcoin rallies, I think that if the Qs rally, Bitcoin is going to rally along with it. There's no reason for it not to, because the markets are confident that there is going to be a dovish bias by the Federal Reserve. They're not serious about fighting inflation. Therefore, the CPI will continue up higher. We know the correlation between the CPI and Bitcoin is very, very tight and positive. So there's no reason to believe that that correlation would be broken if the CPI proceeds up higher on a dovish Fed.
Gotcha. This has been fascinating, Bob. I've really enjoyed this talk about cryptos and CPI with you. This has been great.
Thank you. I don't trade crypto all that much, but I watch it because it's fascinating. It's certainly the future.
Absolutely. Well, thank you again so much for being here today. We really appreciate it, and we look forward to having you back on again in the future.
Well, thank you very much for having me, Jason.
Cheers, brother. Our next guests today are two of the most notable names in the Strat community, Rob Smith and Sara Strat Sniper. You guys, thank you so much for being here today. It's a pleasure to have you on.
Always a pleasure. Thanks for having us.
Thank you.
Awesome. Let's get into it.
Okay, sounds good. So we're coming into an interesting year with rate hikes coming potentially, people getting really lost. And today particularly, and then this will be shown in the future, but particularly a good day to show you what I'm going to show you. So are you seeing my screen right now? Or
Sure
should I have to? Okay, cool. So for people new to the Strat, there's just a couple aspects that you really need to know. Most people are taught classic technical analysis and they're confused for a long time, but this is going to be so crystal clear to you today, you're going to want to know more about it, especially on a day like today. All right, so from one bar to the next on any chart, there's only three things that can possibly happen. You can have an inside bar where you don't take out the high or the low of the previous bar. All right. So when I say there's three things, we call them scenarios. There's only three possible things that can happen. Right. So that's one of them. The other possible thing that can happen is you take out one side of the previous bar. That's a 2. And that could be either up or down. All right. In this case, it's up, but it could be up or down. The third is one of the most important things you can know, is that both sides of previous ranges get taken out. And that's an outside bar. And that's a 3. And one of the reasons that's most important is because that's the proper way to gauge magnitude, right? And so how far is something going to go, right? Most people are taught that support and resistance are horizontal. And if that were true, trading would be very simple. That's not true. If you've ever traded and you've gotten stopped out on a support level only to see it go rocketing into the highs, this is the phenomenon that you're seeing, because right here, they tried to buy up. But right here, when it turns red, that buying is being rejected, all right? And then if that continues here, boom, it's still being rejected. And this was back pandemic. And also what we use is something called time frame continuity. And what that means is price, like when people try and tell me they're going to use moving average and whatever helps you win, I don't care, win. But one of the things you want to know is, are the participants aggressive on the buy side or the sell side? So we'll use multiple time frames and say, okay, it's green on the month, right? What is that telling me? That's telling me that the buyers are aggressive. They're taking the offer. They're not sitting on the bid. That's something I want to know about. And so when you can do that on multiple time frames, we can do the short term for scalping. Main time frames we use are month, week, day, and 60-minute. Because if all of those are green, that tells me that they're taking the offer on a 60-minute basis, daily basis, weekly basis, monthly basis. Think the price is going to go up? I do. So if you look at it, let's say if you're trying to use a 200-day moving average and just using continuity during the pandemic, here you're going to notice this. This was way below the 200-day moving average, right? Yet it was green on the month, the week, the day, and the 60, right? It also happened to be April, which was a new quarter, right? So now you've got quarterly, monthly, weekly, and daily and 60-minute buyers taking the offer. They're steamrolling people, right? Another thing you want to know, that automated trading or algorithms, whatever you want to call them, you have to program it to tell it 4 things. What do you want it to do? Where do you want it to do it? SPY. What do you want it to do? I want you to make it buy. How do you want to buy? Do you want to take the offer, sit on the bid, or sit on the bid? It's like, take the offer. It's like, when do you want it to do it? Now. That's exactly what they told him. So we know exactly what these machines are doing at all times, right? So then there's only so many ways that price can reverse, right? This is one of them, right? A reversal of the 3 itself, because it rejected this buying here, right? An inside bar. This is, even though this was huge, was still a consolidation. So it was 2 down, inside, 2 up, all right? And that can reverse back too. 2 up, inside, back down, right? That's important to note. Then there's a 2-2 reversal, all right? And that's here. 2 up, 2 down. And when Dan programmed this, after I showed him this, he was like, that happens a lot. And I'm like, you bet it does. And once you know that, you can do that all day long on shorter term stuff. So knowing what I just told you, right? Let's take a look at what happened recently, because, that's going back a ways. More recently, and this is very rare, but this is what happened. If we go back here in the last 6 months, you see this here, September, that poked up a little and then started to drop. Once that happens, we know outside bars exist. We know a scenario 3 exists. So anytime all those time frames are red, we're going to take that out for sure. Then what happened? It did it again. It took out the low, changed continuity, and then jammed back up outside, right? Then you had this 2 up, but it was red, right? A little more choppy in here. Then you had this outside bar. What happened here? It took out the highs, then took out the lows, and then came back. And so what that means is, you'll hear me see once a 3, always a 3. You know what that means? If they're willing to pay up and they're willing to sell down and that rejection doesn't continue, they can take it right back up again, because what they're doing is price discovery. We're going to try and take out the highs. No, we're going to try and take out the lows. That didn't work. And then it can come back up. Then January, you take this out. Here, you take out the high. And then boom, everything was doing that, right? So, 4 outside months in 5. And we knew about all of that. And it's not that hard to understand. Also, we do something very important called a simultaneous break to increase probability, all right? How many things are doing that, right? So if you go to January and you had a tough time, you were in the wrong neighborhood, because QQQ also getting pounded. That was a 2 down, a whole bunch of tech, SMH, XLK. This was an outside, this is SMH. This was an outside bar. If you go to XLK, that was a 2-2 reversal to the downside. And all you had to do was understand simultaneous breaks can happen by time or sector, all right? And what I mean by that, in January, if you knew what a simultaneous break was, and usually it's 95% of things are going in the same direction, very difficult to turn around. So if you knew that, you would have known where to be. XLE. What's that? That's a 2 down and that's a 2 up reversal on the month in January, where everybody's getting slaughtered. Did that happen across the board in XLE? You bet it did. Emirata Hess, 2 down, 2 up. ExxonMobil, 2 down, 2 up. So PXD, 2 down, 2 up. It's not that hard. We knew about that all month. So anytime the months that in January that the market stabilized at all, you had crude running and you had all these buy signals over here. And then conversely, when things started to roll, we knew it was going to be tack. It was a big tack rack, right? So we knew where to be on the long side and the short side because of this simultaneous break. So interesting thing too was, let me show you this. Actually, I want to go back. I want to finish off today, really, because we had a simultaneous break today, all right? And I'm going to show you what we knew end of the day, and then I'm going to show you what a simultaneous break looks like on a scan basis, because I can tell you what the market's doing without at least looking at a chart. So today, you'll notice SPY is 2 up on the day, right? Taking out the previous highs. Almost everything was doing that today. If you thought the market was turning around today, you're out of your mind. No way. And so we knew that there will be corrective activity eventually. And if you go to a 5-minute, you might remember this little ditty. They brought it in at the end of the day, and I'm like, get ready. Like, get ready, because here, if you go to the 30-minute, and I'll blow this up for you at the end of the day. This is an outside bar. So here was the corrective activity. And then they attempted to take it down. But the last half an hour, boom, everything's back into full time frame continuity, blasting up into the highs. We knew that would happen because when you have an outside bar and then you take it out and come back into it, we call that a 3-2-2. These two are going to combine to be an outside bar of that. They paid up, they sold down and it didn't work, and boom, they paid right back up. And the beautiful thing about that being in the last half an hour, you have options that are expiring in less than a half an hour. Dirt cheap. And we know how to gauge the magnitude. It's going through there. It was absolutely gorgeous trade. So I want to show you what a simultaneous break looks like in a scan basis. Okay? So here, even if I had no charts, I can go like this. I can search for which stocks are taking out yesterday's high. 2. That means they're a 2 or completing a 3, right? You have AMC, Snap, Apple, NVIDIA, Uber, American Airlines, Intel, Microsoft, Palantir, DraftKings, Delta, Letter X. I mean, everything. Southwest Air, JetBlue, Qualcomm, Starbucks, Visa, AMAT. Do I get my point off? Now, do you know how I know I'm right when it's that big? Then I can go to who's taking out yesterday's lows. Who is at 2 down on the day comparatively? Exxon and Coke, CVS, GILD, Procter & Gamble, Clorox. So that tells me that we had some of the XLPs, which are defensive names. But basically, you go down this list, it's a who's who of nobodies. You got 10-1 on the two to the upside. There's no way that you're going to turn that around. That tells you to wait for the corrective activity and set it up. Very high probability it's going to work, right? So here's another thing that we knew. We use macro charts, quarterlies and yearlies, right? So we also want to have our big boy charts up to see where these breaks are occurring. So what did we know to be true? It broke on the first day of the year. Let's go to the yearly chart. Oh, XLE, 212 reversal year. Triggered on the first day of the year. Did we know about that all month? We sure did. And it's not that hard. I mean, it's pretty crystal clear what's going on when you understand just these very simple concepts. And as I like to go to SPY, we had a lot of outside years last year. We knew about that too. Once they sold down and started coming back, we're going all the way back to the top. We knew that too. And one of the things I like is you can go back in time. You can go way back in time on this thing. Every move ever has been telegraphed. Here, if you go back to 95, 2 up, 2 up, 2 up, 2 up, 2 up. 2 goes up, but changes continuity and starts to go 3, right? Doesn't make it, but goes 2 reversal a year. Outski, 2 down, 2-1-2 year, 2, 2, 2. 2 reversal. Boom, we got a financial crisis. These 2 years become an outside bar of all those years. Then you poke down one more time. oh, 2-2 reversal, you're back in it. 2-year way to glory, right? So knowing exactly what's setting up, why things are doing things, can be very crystal clear for people. So knowing these basic concepts can change the way you trade. And I have people that will do nothing but trade 3-2-2s or 2-2 reversals because it happens all the time. And the reason it works is like especially like you've heard Turnaround Tuesday. Well, the reason that works is because it's negating what guys thought was going to happen on a Monday. So everybody on a Monday goes underwater on Tuesday, right at the level of the next day, right? If it goes up and you take that thing out, we also know that outside bars exist. And so the magnitude on that, you're going to take out the lows of whatever it was before that too, right? And we combine all the time frames. So people can use it for short-term scalping. They can use it for doing their 401ks, whatever they want to do. But it takes the guesswork out of what's happening. Where if you're ever in chat rooms, we're like, "What do you think of?" And do you have an opinion of? I'm like, "There's no opinions here. This is what's happening. Period. Right? And if it's going to stop happening, it's going to have to stop happening on a shorter time period first. So during today's simultaneous break, constantly scanning every 15 minutes to see if that break is still holding, and then because we're looking for that break that we got at the end of the day, and I'm like, here it is. I'm like, get ready. Just backing up to get ahead of steam, and off it went. It was really, really pretty. So that's the simultaneous break importance.
Yeah, so simultaneous break would be, like, just to recap what a simultaneous break is. It's when lots of names are all kind of performing the same action, doing the same thing.
Correct. So the market will trade mostly the most direction of twos or failed twos going three, right? Or ones with continuity. So it has to. That's what's telling you. That's the guts of the market of what's happening. So simultaneous break can happen by sector, like I showed, energy, or it can happen by time, where oftentimes during the day, like everything will break on a 60-minute basis. And I'm like, that's a 60-minute simultaneous break. You got 60 minutes to use smaller time frames to get in, all right? And so it's a much higher probability. And the reason it is when you have a sector-specific simultaneous break, what does that tell me? That tells me that institutions aren't being selective about the companies and saying, well, we like Exxon and Chevron. It's like, we want everybody that has a drop of oil. We don't care. Even rig was up, right? So that tells us what they're doing, right? They were piling into the energy real heavy. And then you could see, conversely, with tech, they want it out bad. Like, and any time you had one of those sell signals in tech, just full on tech wreck. And so it's been good year to know that and be like, this is going to put you in the right place. Where people are trying to catch falling knives or short things that are going up because they think it's up too much. All you're doing when you do that is trying to capture the profit taking of the people that made the real money, the guys that caught the real move, right? That's really all you're trying to do, right? This is what helps you get involved with the real move and have the institutions on your side working for you. It's like, as I like to use as we're coming into the Super Bowl, actually, this is going to be after the Super Bowl, but right now we're recording this before the Super Bowl. I like to explain it this way. The monthly is your offensive line, all right? The weekly is your wide receivers and tight ends. The daily is your fullback and running backs, and the 60 is your quarterback, all right? The quarterback always has the ball. It's a matter of how good his team is, right? He might be able to scramble around for you, all right, and pick up some plays. But once he has all that thing going, that's when you're going to win the game. You're going to steamroll these guys. I got an all-star here. I got an all-star here. I got an all-star here. And when you have the reversals on those, right, that's a play that's working, right? Like a screen pass. Let them come and then dump it over their heads, right? So that's exactly what it's like. And knowing what the institutions are doing, we don't think, I know, right, what they're doing during these periods of time.
That was awesome, Rob. Thank you so much for sharing that with us. Sara.
You're welcome.
Would love to hear from you next. What have you got to show us today?
All right. So kind of just Rob pretty much covered it all, but to reiterate and show with simple graphics, I made a little PowerPoint that I wanted to show. And this is just how we stay on the right side of the market in any direction. And Rob touched on the candle types, how there's 3 scenarios. So there's only 3 things any candle can do. It can be an inside bar, which is this 1. It can be a 2 up and take out the previous candle's high, or you can have 2 downs as well. But the 3s are very important because that shows broadening formations on a smaller time frame. And this is really cool too because there's so many different candle types and dojis and dragonflies, and still they only adhere to one of these 3 movements regardless of what they are. We like hammers and shooters, which show strength or weakness. And I love this about TrendSpider. They have the strat built into it, so you don't have to go looking for scripts or indicators. Everything is already built right into the platform. Full time frame continuity, the numbers, and then all the patterns also. And so this is what Rob was saying, that we know that there's only 3 kinds of candles. We know that they can only reverse and act in so many ways because it just is what it is. There's only 3 candle types, so there's a limited number of ways that things can continue and things can reverse. So knowing this, we use this sheet. This is our setup sheet basically. So this is kind of the tip of the iceberg as far as the strat goes. The strat is not just this sheet. The strat is what Rob was saying. It's time frame continuity. It's time. It's the flip. It's broadening formations. It's knowing your targets. So using all these things, we have very clear entries, targets, and stops. We know, for example, if we have full time frame continuity to the downside, meaning your month, your week, your day, and your 60 are all red, and we get a 2-1-2, we're going short when this candle opens and takes out the inside candle, and we know where our target is, and we expect this to happen. And if it doesn't, you stop out right there. Your losses are small. And this is just to, I think a lot of traders had trouble in January when we got this huge outside bar. But you'll notice, so the flip, which is any new candle forming, which is part of the time frame continuity principle, we open the month. This is SPY. We open the year, the month, the week, the day, everything at this level at 476. So anytime we were below this during January, even though we were up at all-time highs, and people are normal technical analysis, the trend is intact. You got, people are trying to buy the dip on the 20-day, but we know that full time frame continuity is red. And we also know about outside bars. So I'm going to get into, I have a little section on outside bars, so I won't get too into that right this minute, but we know that anytime price is under this line, we have full time frame continuity to the downside. And we know not to buy the dip because we know what our magnitude is. A 3 is always to take out the other side of the previous candle. This goes over multiple time frame analysis. So this is the month, the week, the day, and the 60. You'll notice that all of the time frames are red. So the monthly is red, the weekly, the day, the 60. So this means that you should have a bear bias. You should not be trying to buy the oversold dip. You should be playing with the trend. Like Rob was saying, you don't want to be trying to collect the scraps at the profit taking, the tops or the bottoms. You want to be taking the whole move. This is another thing about the broadening formation and exhaustion risk. You'll notice, see these red arrows? Every time we hit a new high or a new all-time high, what happens? It's not sustainable. So you'll make a high, and then a low, and then a new high, a new low. This is a broadening formation. And also back to Rob's point about support and resistance not being horizontal, because if that were true, we would never make lower lows or higher highs. So breakout traders struggle with these broadening formations because they're taught to go long above well-known pivots. And that's where like the smart money is getting out. Smart money is getting out at new highs. Breakout traders are getting in. So we want to be in from down at the bottom from reversals. Once we make a new low, we want to be in and catch this whole move and not try and catch the breakout top, which is again exhaustion risk because this is new price action. There's, Rob always says we have to be playing against somebody, and you always are playing against somebody. But if you're at all-time highs, there's no orders up here. There's no shorts to be short against to blast the price higher. So that's when Rob will say, buyers have to keep stepping up. This has become, so this is an outside bar. This has become my favorite strategy ever. It's gauging potential outside bars. So what we have here, let's just look at the green candle. It's a 2 up because it broke the previous candle's upside. So it's a 2 up. This candle opened right here, tried to go 2 up, started falling back through. So this is the rule. It's called, we've hashtagged it on Twitter. It's called the SSS 50% rule. And you can also search that hashtag for tons of examples and real life charts, and people are posting everywhere. So once this fails, the 2 up fails and turns red, that's also when continuity changes. So your short bias. And then once you retrace 50% of the previous candle, I'm not going to say we know, but more often than not, you're going to take out the other side of this candle. So that's the target. So you can enter up here if you want on a time frame continuity change, but I teach people to look for an actionable signal around the 50% retracement because we're always using multiple time frames. So this is a monthly candlestick, but it could be a 60-minute, it could be a daily candle. This outside bar works on every time frame. So let's pretend this is a daily candle and we're at the 50%. You might look for an actionable signal on the 15-minute or the 30-minute to get in, so your stop is closer instead of all the way up here, because that's too much risk. So that's how we use multiple time frames also to lessen our risk and get better risk reward and a higher probability trade. So yeah, this is a really fun one. I feel like people used to be really afraid of threes, but now they're loving it because they know what it's doing. They're starting to understand it. And again, back to the strat combo sheet, knowing when to take profits, when to enter, where you stop, or I just messed that up. Where to enter, where your stop loss is, and where your target is. Now, the strat combo sheet does not have wicks included on the candles, but pretend that they're there. We use the candle's highs and lows, not the candle bodies. So this is like what it looks like on This is what it looks like on the strat combo sheet. And on the right side, this is a real life example of a 2 down, 2 up reversal. And candle color doesn't matter in deciphering if it's a 2 down or a 2 up. Its direction, it broke from the previous candle, is what determines it. So this is a 2 down, but it's red. This is also a 2 down, but it's green. That's okay. You're still playing the reversal, a down and then an up. So just like in the picture over here, your entry is a break above the 2 downs high. So right here, just like it is right here, when this candle opens, breaks the high, you're in. That's target 1, that's target 2. So just like over here, enter, this chart only has target 1. So, but this is how we take and apply the combo sheet to real life candles. and stop losses. So us in the strat, we do not use stop losses as worst case scenarios. We use them as guarantees to either lose a little bit or lock in our profit and walking our stops up. We never, ever let a green trade turn red and go against us. So your number one job as a trader is to protect your money. If you do not protect your money, you will not be able to stay in the game and learn the strat. If you want to hit up me or Rob, you can find us on Twitter. Rob's handle is @RobinTheBlack, and I am @TradeSniperSara. We both also have YouTube channels. You can just search our names. And thank you for having us.
Awesome. Thank you so much for that presentation, Sarah. One question that I have is, you guys talk a lot about the importance of full time frame continuity. What if full time frame continuity doesn't exist? What if you're not seeing it? Then what do you do? What do you do?
Full time frame continuity does not mean every time frame possible is the same color, because that'll never happen unless you're at all-time highs or all-time lows. It depends what kind of trader you are. I tell people the 4 time frames surrounding their time frame. So if you're a daily candlestick user, you want to have those 4 time frames right around the daily. So you might want so start with the daily, the 4 hour, the hourly, and the weekly. So those 4 time frames. So as long as you have the 4 time frames in alignment next to your time frame, that's good enough.
Also, if I could take part of that,
Absolutely.
or am I mute? Okay, so there's something called control. And what that means is who has the ball, all right? Who has the ball? So when the monthly is red, but the weekly is green, and let's say the daily is red, that 60 has control. There's conflict in there. So control is always in the hands of the quarterback, the 60, always, right? So no matter how much control he has. Also, as Sarah just showed you the price targets on the signals, it's important to know that if that can change continuity, that's another thing I want to know about. That's another type of reversal, a continuity reversal, right? So you want to know about all that stuff combined. Is it going to change this? And because what we're doing is identifying participation groups by price and time, let's say the month is red, but the week and the day and the 60 are green. I can't identify those monthly sellers are here. They might be gone. So as far as I'm concerned, they're gone. And so that's where you're going to see where Sarah was showing you the broadening formations. It's like everybody's like, well, how can you buy at the bottom of the triangle when it's got to have continuity to the downside? I'm like, when things occur matters. Now you got a new month, everything, and a new week. Now you can come back green and rip back through. You see? And so that's how that can happen. And there's another reason it's important to understand the 3, the outside bar, right, with continuity. Why would this be more powerful than anything else? And I'll tell you why, because we already know institutions are buying or selling something, right? But when you come back to the previous range, you're going to stop people out. And what that does is that turns buyers into sellers by getting stopped out. What that does, it removes liquidity. So the machines don't have as much to hit. So if you've ever experienced slippage when you're trading, these guys get big time because it's like a group of porches falling down. These guys take out these guys, take out these guys, take out these guys. And you've got machines and people hitting bids, right? So that's why you want to come back to a previous range and know about this.
Interesting. So then one more question for you guys before we go. It's the big question that everybody wants the answer to. Where are we headed next? What is the strat saying about where the market is right now?
Right now, you are inside on the month. For SPY, the question is you're a 1 and you're dead in the middle. So you can expect the chop back and forth. So we're constantly monitoring all the signals, right? Who is a 2 on the month? Who is a 2 up? Who's a 2 down? Who's going 3? Who's going 1? So SPY, you can see that dead inside. How are you going to get out of there, right? So we're constantly monitoring the continuity and then the shorter term signal. So right now, like when I just showed you all that simultaneous break on a daily basis to the upside, a lot more things are taking out last week's highs and taking out last week's lows, period. So that's how it would start. So, but we're going to have to keep monitoring that as we go along. Also, as I showed you, that we'll stick on a lot of these energy yearly signals. Doesn't mean they're going to go up every day of the year, but that signal is good all year. There's something we call in force. So once one of these signals is in force, it's good until it has a reversal against it or it hits its target, right? So on a macro basis, we're still watching the energies. We want to see how we resolve this inside month. How are you going to get out of there, right? How are you going to get out of there? That's what you ask when you, because a lot of things, as she just showed you, the one in the middle of a giant three, the reason that happens is the market likes to screw a lot of people, right? So the three wipes a bunch of people out, right? So a lot of people figure, well, it's volatile now. I'll just trade my way back. And then do you know what it does? It dies and does nothing. So you can't get your money back, right? That's what it's doing, because a lot of people are freaked out from January. So that's what's going on.
Yeah, we really need a 1. We really need February to end as a 1. Would be nice.
And then for all traders who are still on the sidelines, kind of waiting for the right time to make a move here, pending February ends in a 1, what are we looking for a continuation to the upside? What are we looking for a continuation to the downside? Just essentially like a 2U or a 2D?
Yep. You would want a 2 up or a 2 down. So the 3-1-2 is a great strat setup as well. So you would just play so pretend that this candle was closed. When March opens and we break above February's high, that would be the long entry, and you would target a new all-time high up at 480. That's literally it. And then the short signal would just be the opposite. You would short in March, or if you don't short, whatever, but close your positions or manage your 401k, have your stops in place if that's what you're going to do, and then you're targeting that low. It's just,
and that's why once this is happening like this is now, I do the Strat Attack show on my YouTube every Tuesday. One of the things I talked about, we want things that are taking out last month's highs. Why? Because anybody short stuff from January that is still short, that's where they all go underwater, and you're seeing that in the pandemics. Airlines, restaurants, all that, hotels, they're all taking out last month's highs. They're too. All right, now there's exhaustion risk by doing that, but that's where we want to be. I want to be trading against the people in losing positions. So that's what we're also doing here, is saying, okay, we know we got a 1 in the SPY. You can expect that to chop back and forth. We're nowhere near taking that out. We'll see you later. But for right now, when the market firms up, anybody taking out last month's highs, that's somebody I want to talk to.
Interesting.
And not in a nice way.
What are the names that are taking out last month's high off the top? Are you trading them right now?
Off the top, you got United Airlines, American Airlines. So a bunch of airlines. You got Wells Fargo, Delta, some energy still, Oxy and MRO, Visa. So there is a list there. You just have to know what it is. All right. Brinker, EAT, these guys, and I talked about it all in the Strat Attack last night. And it's like, at least, because right now, as it stands, we're still an inside week, right? We're still 1 on the week, right? And in the Qs. So we have earnings coming out. So I was like, look, you want to trade where the 2s are, right? On the weekly basis, if we firm up, because those guys, anybody who shorted last week, underwater. We'll go talk to them. We got, like I said, Wells Fargo, JP Morgan, I think Bank of America, up to some financials in there as well. Also, some inflation trade stuff coming up. Alcoa, SCCO Copper. Some of those guys are coming up here too. XME. So always breaking the market down by sector. So, and at any given time, if we have a shorter term signal, like I said, quarterbacks going up, here's all the things of buy signals. Quarterbacks going back down, here's all the guys who are taking out last week's lows, right? Always trading against those guys, or guys who, if the setup works, like Sarah was saying, will take it out, right? If the shorter term setup's going to set up and you've got these 3s forming, that's where it's going.
Got it. Well, this was awesome, guys. Thank you so much for being here today. I wish that I could just hang out with y'all all day and talk about the strat. This is right up my alley for sure.
Awesome. Yeah, once you see it, you can't unsee it. And that's all you see, right? You just got to train your mind to see things our way. TrendSpider makes that very simple because the numbers are right there. And you can search for the actual setups and it'll come right on it. So it'd be like, I'm just a 2-2 guy. Where's they at? I'm like, here, right? And that's right here, So confidence in trading comes in knowing what's happening, as opposed to the subjective where people say, oh, you need screen time and you've been trading for 5 years and you're still white knuckling every trade. With us, we've got utter confidence something's going to work. And if it doesn't, we just get out. But another analogy I use with the strat in trading is because we know how to gauge this big magnitude on threes, it's like home run derby in baseball. So we might foul some balls off, but once you get a hold of one and you get in your groove, they're gone. I mean, it's just gone. Slow pitch, gone, right? And when all these things start firing and you have a simultaneous break like today, I'm like, go buy everything in sight. Boom, boom, boom. All of them are going. Everything's working, right? So that's kind of how it works. Like I said, you can have some days you can foul some balls off, but you ain't going to get hit and you ain't going to, that's all that's going to happen.
Right. Well, Rob, Sara, thank you so much for being here today. We really appreciate it. It's been a pleasure. And we look forward to having you guys back on again in the future.
Yeah.
Thanks for having us. Definitely.
Anytime you ever want to chat about the strat, I'm available.
Right on. Yeah. You might be hearing from me then.
All right.
Our final guest today is Michael Baiynd. You may know him from the LeadLag Report. He's also the portfolio manager at Toroso Investments. Michael has been using the lumber to gold ratio to predict market moves, and today he's going to talk to us a bit about that ratio and what it might be saying about where the market is headed next. Michael, thank you so much for being here. Great to have you on.
Yeah, no, I appreciate it, guys. Thank you. All right, so I guess we'll get started for the conversation/presentation. So, as mentioned, my name is Michael Baiynd, publisher of the LeadLag Report, portfolio manager of 3 funds. I'm somebody with skin in the game as a trader running a mutual fund and ETFs using various indicators that I'm known for having published research on that won various awards. This presentation is going to be on the lumber to gold signal, which we're going to talk about in the context of TrendSpider for some of you to try to track on your own using the software. I like to call this presentation before it's too late, because unfortunately most people only realize that a trend has changed after it's already changed. I often say in my conversations to investors and other financial advisors that I may not know the exact mile marker that I might crash my car, but I know the conditions that favor an accident, and those accidents are what causes trends to reverse. So a lot of what we're going to be talking about here is around conditions that you should be aware of for when trends might be changing using a seemingly bizarre relationship that I'm going to prove to you has real merit in lumber to gold. So as mentioned, a couple of things real quick about me. I'm portfolio manager at Toroso Investments, RIA, about $8.5 billion in assets. I'm a 2-time Dow Award winner from the CMT Association, 3-time NAME Founders Award winner, and published a premium research that I call the LeadLag Report. If you're curious, check that out at LeadLagReport.com. I used to be in the media all the time, used to be on CNBC, Marker Watch, was one of their top writers. Please don't hold that against me, by the way. And if you have any questions about anything that you see or hear in this presentation, feel free to reach out to me, Michael Baiynd at LeadLagReport.com. Just please don't spam me. Okay, enough about me. I'll start off with a quote that I think every trader needs to have on their wall. The quote is, "There's always a disposition in people's minds to think that existing conditions will be permanent. When the market is down and dull, it's hard to make people believe that this is the prelude to a period of activity in advance. When the prices are up and the country is prosperous, it is always said that while preceding booms have not lasted, there are circumstances connected with this one which make it unlike its predecessor and give assurance of permanency. The one fact pertaining to all conditions is that they will change." That is by Mr. Charles H. Dow from the Dow Industrials Average when he said that in 1900. Not too many things change in history except conditions, right? So that's what we're going to be talking about in the context of this research. Now, everything that I do uses a school of thought called intermarket analysis. Intermarket analysis is a branch of technical analysis. As we all know, technical analysis, like a lot of what you see with TrendSpider, is focused on charts where, in theory, you don't really care what the chart shows. Here's support, here's resistance, here's a trend line, so on and so forth. Intermarket analysis is different in that it's meant to look at the interaction of different charts to each other. What does the message of the bond market say about oil? What does oil say about stocks, about currencies, so on and so forth? Sort of the interplay across and within various asset classes. And the idea there is that relative movement can tell you a lot about changes in market dynamics, changes in the economic cycle, booms and busts, so on and so forth. I have here a picture of the book cover of my father's book on intermarket analysis and investing that I republished in 2013. Even though the book is 30 years old at this point, it still has pretty high reviews on Amazon. It goes back to this point that not much has changed over decades. Human behavior is still human behavior, which is why this stuff is worth paying attention to. All right, so what are some of the ways that we use intermarket analysis? That's the whole point of this presentation. I'm going to try to truncate this a little bit given time constraints. So if you ever want something a little deeper, again, don't hesitate to reach out to me, primarily through Twitter at LeadLag Report. But I'm going to divide this up into two main sections, one on asset class diffusion, two on various strategies to prove this works, and then I'm going to go through a couple of real-world historical examples to prove that lumber and gold tell you something about risk on and risk off more often than not. Okay. So let's start off with this idea of asset class diffusion for a moment. So if you ever do any kind of studies, ever look at different research studies, white papers, a lot of studies on markets tend to look within an asset class to isolate a particular factor to focus on. Think value, think momentum, factors like that. A different approach is to look across asset classes to see if there's some information that one area of the marketplace might tell you about another area of the marketplace that area of the marketplace has not yet noticed. And the idea here is that there's this gradual diffusion of information that takes place across commodities, equities, bonds, currencies that might tell you in advance of changes in risk-seeking or risk-averse behavior. And that relative movement, is something you can identify and position for in advance. And it turns out that the relative movement of lumber to gold does tell you a lot about changes in risk-seeking, risk behavior in terms of when to play offense and when to play defense. Okay, so what do we mean by that? We'll get into that shortly as far as what the offense-defense means. But let's first tease out why lumber. What's so special about lumber? So you often hear in the media people talking about oil, talk about Dr. Copper as a leading indicator of the economy because of what it suggests for cyclical activity, industrial activity. Most investors are probably underestimating the importance of lumber. And the reason I say that is because most people don't realize that lumber is the key component that goes into housing. And we know that housing tends to move ahead of major expansions and recessions. Lemur showed in his research that permits are critical to that. With the average home, again, has about 16,000 board feet of lumber. And when you look at housing starts data as shown by Rucker, Thurman, and Yoder, when housing starts data comes out, lumber prices pretty much react instantaneously. So it kind of makes sense that if we know that housing is a leading indicator of the economy, well, then lumber, by extension, must be as well because of the long tail of construction. So lumber, in many ways, is sort of your main cyclical leading indicator. I would argue much more so than oil and copper. You can see that visually here real quick when you look at U.S. building permits. Again, typically, building permits will rise in advance of an expansion and fall in advance of a recession. Most major declines are preceded by weakness in housing. Full stop. There's another interesting dynamic when it comes to lumber, which is that, believe it or not, it's regulated. In 1973, Congress passed the Endangered Species Act, the effect of which was to remove rainforests from being deforested, which, oddly enough, took trees out of the market in terms of their usage for housing. And what that means is that increasingly the price behavior of lumber is more dependent upon demand than supply, which is fairly sticky in that sense. Okay. Now, what about gold? A lot of people get gold wrong. They talk about gold as if it's some kind of inflation hedge or deflation hedge. Gold does not correlate to really anything. You can see that here, gold's rolling correlation against the S&P 500 is historically around 0. There's no real statistical correlation between gold and most other areas of the marketplace. The one thing gold, however, does tend to correlate to is risk-off high volatility environments for equities. So you compare lumber, which is highly cyclical and tied to housing, to gold, which is non-cyclical and tied to risk-off behavior. Well, then it actually tells you a lot about equities. So in the research paper, Lumber Worth Its Weight in Gold, the backtest was very simple. And by the way, I give a lot of credit to TrendSpider for putting a big emphasis on backtesting. Everybody that is a trader, please backtest. Don't just follow things blindly. See if what your belief is has merit, right? Because if you don't backtest something, it's all just nonsense, in my opinion. But the backtest in the paper is very simple. First of all, it looks at the rolling 3-month behavior of lumber relative to gold. 3 months was chosen because, as Mifre and Rallis showed, when it comes to the entire commodity landscape, momentum tends to be strongest in the 3-month time frame. So, and it works beyond 3 months. It works as short as 3 weeks, as long as 26 historically. But let's go with 3 months, which is basically a rolling 13 weeks as the look back period to evaluate lumber to gold. And let's make a very, very simple rule. If lumber is performing better than gold, outperforming gold, just straight up performance over the last 13 weeks, let's call that offense, go risk on. If gold is outperforming lumber, let's call that defense, go risk off. And you evaluate that relationship of lumber to gold every single week for potential changes. Okay, so very active in the rotations. Now, if you're going to focus on any part of this presentation, this is the key. And this is really key to a lot of the work that I do, key to why I frame things the way that I frame them on Twitter and the LeadLag Report, as well as in my mutual fund and my ETFs, Roro and Jojo. Whenever I talk about risk on, risk off, I am not talking about direction in the stock market. When you hear me say risk on, risk off in this presentation, I'm not talking about direction. I actually am not talking about trend. I'm talking about conditions that favor an accident where trends break. Okay. So one of the things that's documented in that paper is that historically, when lumber is outperforming gold over the last rolling 13 weeks, the S&P 500's volatility, factually, on average is around 12.5%. When gold is outperforming lumber, that volatility rises quite a bit to an average of 17%. Again, this is really important. This is not about trend. It's about volatility dynamics changing. And that matters because it's in those higher volatility states when you tend to have the accidents. In other words, the major crashes, corrections, bear markets, they tend to occur when you're already moving around violently in equities. And whether you're trading ETFs or individual stock positions, everything correlates to one in higher volatility regimes. That's why the behavior of lumber to gold is important. Okay. Another way to look at that with the VXO index, I'm going to skip that. But now let me prove to you that this works for the remaining 20 minutes or so. Okay, so first of all, whenever you do any kind of back test, you've got to define your opportunity set. Okay, how do you define offense and defense? The way the paper was constructed is that it goes from lowest volatility asset class to highest volatility using different indices as the proxy. So the least volatile asset class from a risk-off perspective would be 5-year treasuries. Right, kind of intermediate duration-ish. You can see annualized volatility 4.2, beta to the S&P, roughly flat. And then you move up the risk spectrum, in this case moving down the list, to the S&P 500 buy right index as risk off, the S&P low volatility index as risk off. And then you've got the S&P as your baseline in the middle. Russell 2000 small caps, risk on. Morgan Stanley cyclicals index, risk on. You can use Russell 2000 growth also as for a proxy for cyclicals, risk on, and then high beta. So just think of this as a spectrum of risk for how aggressive to be on the offensive or defensive side. Okay. Now, I'm going to show you a few different back tests to prove that this works no matter how you slice or dice this. And again, I'm going to frame this in the context of what you are doing within TrendSpider, because I go back to no matter what stocks you're tracking, they tend to correlate in the extremes. So paying attention to this kind of behavior and the opportunity set for risk off is going to be really important for longer term success. All right. So the best defense when it comes to investing is not to go cash. It's not to go short. The best defense historically is to go into treasuries. Now, some people may say that's nonsense, except that the reality is that treasuries as a risk-off asset time and time again have proven that when you have these high volatility risk-off periods take place, There's a flight to safety in treasuries, yields drop for a moment in time, and treasuries for a moment in time act like inverse the S&P. They actually make money when stocks go down. Now, it's important that that behavior is there during high stress periods for equities, because when you're in false signals, when you're risk off and the market does not act volatile, treasuries are not perfectly inversely correlated to equity. So what that means is that treasuries allow you to be wrong but still make money when your signal is not working. And by the way, if you do any kind of back testing within TrendSpider, you're going to see there are plenty of times when a signal looks like it's not working. The key thing is, does it work over a prolonged period of time with multiple rolls of the die? That's why the opportunity set's so critical here. So the way that this backtest is constructed, don't focus so much on the numbers. I'll kind of talk through it here, but it's very simple. If lumber is outperforming gold, you go risk on the S&P. If gold is outperforming lumber on a rolling 13-week basis, you go risk off treasuries. Very simple. Long S&P, you can put on your watch list, or long something like IEF or TLT as treasury tickers, right? To kind of roughly get to the same place. And I'm sure that we're going to show it here on the screen, but you can track lumber to gold within TrendSpider, track the lumber chart as well as the gold chart as well. But if you do that very simple rotation, the LG bond strategy here, you see that the cumulative return is around 3,300%, which is pretty good going back to 86 through November 2020, last time I updated this, which slightly outperforms the S&P. On the one hand, you say, well, why would I want to be so active with something that slightly outperforms the S&P? Well, notice that the annualized volatility is about 10% of that rotation strategy. The S&P's volatility is 16.8. Notice that the max drawdown, your peak to trough decline in that strategy, 16.8 or 16.1. The max drawdown for the S&P is 54. So you're getting to the same place, even slightly better, as a buy and hold of the S&P without suffering the massive declines. Another way to visually look at that is to look at drawdowns. This is a chart that looks at the drawdown of the S&P 500, the peak to trough decline in the S&P versus the peak to trough of that rotational strategy. And you can see that the red being the S&P, the blue being that lumber gold rotation approach, the drawdown is a hell of a lot less. Now, this is really important. And for everybody that is a fan of TrendSpider and is a fan of trading, please keep this line I'm about to say in context and remember this, because I think this is critical. Your ability to stick to a strategy matters more than the strategy itself. Your ability to stick to a strategy matters more than the strategy itself. I don't care what diet you follow, you will lose weight. As long as you stick to it. What prevents people from sticking to any investment strategy, any trade? It's not the annualized performance, folks. Too many people focus on the returns. You focus on the drawdown, because the drawdown is what's going to determine your likelihood of sticking to the trade, of being disciplined with your trend following process when the trend suddenly breaks in that drawdown. So to the extent that you can minimize drawdowns, that's really important, because I would argue you're more likely to stick to a strategy that does that than buy and hold, where you might suffer 50% type declines when the trend is against you. Okay? All right, I'll skip the buy right version. Let's kind of go to Russell to another variation of this risk on, risk off. What if instead of saying risk on, risk off equities, treasuries, you change the opportunity set so risk on is S&P, but risk off is S&P low volatility. So you're still equities. You're always beta. You're simply lowering your beta risk as the risk off expression. And low beta tends to be utilities, staples, healthcare. The areas which don't look that interesting on a chart, but tend to do pretty well over time, given their low volatility status. So if you do that very simple rotation of beta of 1 or beta of less than 1, risk on, risk off respectively, lumber beats gold, SPY, S&P, gold beats lumber, you look at something like SPLV or a low beta S&P type proxy. That rotation yields gets you about 4,000 plus % backtested return. The S&P is around 3,000%. And so you end up beating, by the way, a constant buy and hold of a beta of 1, even though the riskiest thing you're doing is going risk on with a beta of 1. It goes back to playing defense, identifying conditions where the trend breaks. It's far more important than the upside. If you want to keep using that line on Twitter on at LeadLag Report, if you want to kill it in the stock market, you have to not get killed over long periods of time. And again, you can see that when you look at the volatility, it's less than buy and hold of the S&P. You look at your max drawdown, it's quite a bit less than the S&P, and yet you're always equities in this case. You get much better convexity, much better outperformance being risk off in treasuries. But if you want to always be exposed in equities, instead of trying to ramp up your risk, maybe you want to ramp down your risk. And think about other types of trend setups in defensive areas that wouldn't get hit as much if the market does go down heavy. Okay. I showed you two examples of risk on, risk off from the standpoint of the risk off side, where risk on was always the S&P. I'll show you two quick examples of risk on, risk off, where you're playing with the risk on, because let's face it, everybody always wants that high octane type of trade, right? That's what everyone's trying to get a setup on when you're looking at trends. So let's change the opportunity set. Rather than risk on, risk off being S&P and treasuries, let's make risk on, risk off large cap or small cap. Large cap being risk off, small cap being risk on. Okay, so all you're doing in this backtest is ramping up your risk by lowering your average market cap to small caps Russell 2000. Think IWM as a proxy. And large caps would still be SPY. So lumber outperforms gold, small caps. Gold outperforms lumber, large caps. Always equity is simply playing with market cap differentials. If you do individual stocks, think about that from the standpoint of the market cap of your stock, as being the small cap, play versus the larger cap, bigger company play. So that rotation of large to small using lumber to gold gets you 6,400% returns, which destroys a buy and hold of Russell 2000 small caps and destroys buy and hold of S&P 500. So the rotation of large to small actually massively outperforms a buy and hold of large or small. You look at the max drawdown, still less than a buy and hold of either. You look at the volatility, slightly above the S&P, massive alpha outperformance. Why does this work when it comes to market cap on average? And on average is the key here, because obviously this hasn't been the case the last year from 2021 to 2022, as small caps have been quite weak, right? On average, why does it work? Because lumber tells you about housing. Housing tells you about the consumer. Small caps are more sensitive to the domestic consumer than large caps. So if you go with that thread, it makes sense that when lumber is doing well, small caps should be the bigger beneficiary versus multinational large caps. And I think that's always something worth keeping in the back of your mind in thinking about cap as far as what to trade and what kind of trends to kind of follow. And then I'll go through another example here, taking it a little bit further. Instead of just Russell 2000, what if we did Russell 2000 growth? Okay, well, let's go a little bit tilted towards the growth cyclical kind of style tilt on Russell 2000. Again, hasn't worked the last year. A lot of false signals, but that's okay. That gets you, if you look at risk on, lumber outperforms gold, 5,000%. Gold outperforms lumber, S&P, again, 5,000, 5,500%. Massively beats the S&P. Okay, so again, I'm showing everybody here, all of you who are TrendSpider users, I'm trying to give you some perspective that oftentimes when you think about trading, you have to think about the environment, the condition that you're in. Lumber to gold tells you about dynamics that favor risk-seeking or risk-averse behavior, which can help you identify which types of stocks to overlay your trend analysis on, using lumber to gold as your key tell for where to focus your attention. Okay. Now, what if you combine the two? Best defense historically is treasuries. Best offense is equities, as small caps in particular. If you do that rotation, you can see in the blue line, massive outperformance going long small caps or long treasuries. That trend looks pretty smooth compared to a buy and hold of the S&P, and it results in really substantial historical outperformance on average over time. Okay. Second most important slide to look at here is this one. Why does this work? Is it because lumber is outperforming gold, or because gold is outperforming lumber? Is it because of risk on or risk off? There are these metrics called up capture, down capture. What percentage of the upside is this strategy capturing when the S&P is positive versus when the S&P is negative? Note that the up capture of that strategy, which I showed you, looks phenomenal on the prior slide, that blue line. Notice that the up capture is meaningfully less than 100%, 64%. Meaning that if the S&P is up 10%, on average, this is up around 6.4%. So it lags pretty badly. It's underperforming, right? It should make sense it lags on the upside. Why am I saying it should make sense? Because there are plenty of times where gold outperforms lumber, you're risk off and you're wrong. You slow down entering the storm, you never have the accident. You get whipsawed playing defense, and the market keeps going higher. If you're a trader, I'm sure, have experienced that at some point in your journey as a trader. So you have to be lagging the stock market because you're not always in it. There's no way around it. Yet this chart substantially outperforms buy and hold of the S&P, rotating around equities and treasuries despite lagging the up periods. How does it outperform so substantially? Because it's not about the upside. It's not about the risk on. It's not about the uptrends. It's about the downside. It's about the accidents. The down capture is about 25%, meaning that if the S&P is down 10, on average, is around down around 2.5. Why? Because you are in treasuries in advance of the real nasty declines. Your up is more than your down. I know this sounds rudimentary, but it's really critical. If you want to beat the market over time, you have to focus on being down less when it matters the most, when the conditions favor the accident. And it turns out lumber to gold tells you about that. Now, real quick, I'm going to go through some proof examples here. Series of charts during major market sell-offs. Okay, top chart is the ratio of lumber to gold. Okay, and you can again track this on TrendSpider, just looking at the absolute behavior of lumber and track that against the absolute behavior of gold. But ratio of lumber to gold, rising ratio means risk on, falling ratio means risk off. 13-week rate of change on the ratio, which is your trigger for risk on, risk off. Above the zero line, risk on. Below it, risk off. S&P in blue. And then VXO, VIX-like index in red. This is 1987. Notice before the 87 crash, the dotted line, the risk-off signal comes in. You could have avoided Black Monday and the entire 1987 crash simply paying attention to lumber to gold. Okay, maybe that's luck. Well, here's 1990. You had a recession driven by housing. Makes sense, lumber should see it in advance. Same series of charts, lumber to gold up top, 13-week rate of change, S&P, and then VIX. You can see that, again, prior to the second half sell-off, prior to that bear market, lumber to gold also warned in advance. Okay, maybe that's also lucky. All right, well, here's 2000, 2001, 2002. Look at the VIX at the bottom. In every single major juncture where lumber to gold weakened in advance, VIX spiked afterwards. Before it was too late, lumber to gold warned you. Now, again, keep in mind, just because lumber to gold is warning you of risk off doesn't mean you're guaranteed to have risk off. All right, just because it's raining doesn't mean you'll crash. It's that the odds favor it when you have lumber to gold being weak. Okay, in advance, you can have avoided these bigger declines. Those of you who have been actively trading since 2008, you'll remember Lehman Brothers. Believe it or not, 2-3 weeks before Lehman Brothers went broke, same deal, warned you in advance before it was too late. You can see very clearly lumber to gold warned of a risk-off period. You could have avoided basically the great financial crisis crash of 2008. 2011, European crisis, summer crash of 2011, debt downgrade. Same deal, right before the summer crash of 2011. Lumber to gold warned in advance. You could have avoided that highly volatile period. You could have maybe benefited from that highly volatile period. 2018, fourth quarter, okay, when you had the Christmas Eve massacre, when stocks collapsed, same deal. But now in this case, for 2018, notice that the warning sign was really early, right? So this warned back in July of 2018. You didn't have the real sell-off until November, December. Same deal. Lumber to gold warned of risk off in advance of the tail event. And then, of course, the most recent big decline, the COVID crash. Yes, even with COVID, this warned of risk off in advance. Okay. So, again, the key takeaway is defense matters more than offense. You can track these charts on TrendSpider. Keep on your watch list your selected list of risk on plays. Keep on your watch list also your set of risk off plays, which tends to be treasuries of varying durations. And be very aware when lumber to gold is weak. Not that it's necessarily going to tell you in advance that it's guaranteed to go down, but simply that it's starting to rain and you might want to slow down. This, of course, is my Twitter profile on @LeadLag Report with lumber and gold eyes, quasi making fun of the laser eyes community when it comes to Bitcoin. But if you are curious to learn more about the papers, they're available by just Googling my name, SSRN, Social Science Research Network. And of course, I encourage everybody selfishly to check out LeadLagReport.com. There's a free trial. And of course, if you're not a subscriber to TrendSpider, you might want to consider it.
That's really, really fascinating, Michael. Thank you so much for sharing that with us. You know, just as a relative newcomer to this particular ratio, I was looking at it over the past couple of days, and just basic technical analysis right now looks like maybe a failed new high, right? Or a lower high. Is that something that you're kind of seeing as well? Where's your head at on where this ratio or what this ratio is saying like right now?
Yeah, it kind of makes sense, right? You'd expect that because we all know housing has gotten insanely unaffordable, right? So at some point, that's going to have to start to abate to some extent. Keep in mind that as much as I'm showing lumber relative to gold, lumber by itself is also predictive. So even if you overlaid a simple moving average on lumber by itself, you still get to roughly the same conclusion. It's just that it tends to be much more accentuated and let's call it quote unquote accurate if you compare it against gold. But to your point, if lumber is turning down, all that means is just be careful because it means you might be having a disinflation scare coming. That's starting here. Now, oddly enough, it's starting after the market already went down, pretty heavy to start 2022 here. So on the one hand, you say, well, maybe it's a delayed signal. It's not leading, it's lagging. I don't disagree. Or maybe a bigger risk off is yet to come. But my point is that if you're going to follow any kind of signal, you have to be careful not to editorialize it too much if it looks like it's wrong in the moment. That's why I go back to your risk off asset really needs to not be shorting or needs to not be betting against the prevailing trend, because your opportunity set is as important as your signal. And ideally, again, you want an opportunity set that allows you to be wrong if lumber itself is weakening. You want to make sure your opportunity set doesn't hurt you too much if that signal is a false signal.
Right on. Well, thank you so much for being here today. This was super, super fascinating. I really appreciate it. I'm definitely going to be keeping my eye on that ratio going forward now.
No, I appreciate the invite, guys. Thank you.
Cheers, Michael. Thank you so, so much to all of our guests for sharing their time and their knowledge with us today. And thank you for tuning in. We'll have new episodes of Talking with Traders and chart requests coming up really, really soon. And if you're not currently a TrendSpider user, but you're thinking about getting an account, now is the perfect time because we have a 30% discount code available for you today. You can find that in the chat in the description below. So have a great weekend, and we'll catch you next time.